more and more an issue. We haven't had briefings here in a couple of weeks because of the president's travel and some personal issues. Of course, the health issue that the press secretary is having with her COVID case, and of course, we wish her and her family a speedy recovery. But I think, you know, this has been an issue that they've wanted to not really talk about. I mean, they want to talk about what they're doing in this Build Back Better bill to sort of help people, checks in their mailbox, you know, child tax credit extension, that kind of thing. And of course, in the meantime, people who've been going to the gas pump every week or whatever have been, you know, really seeing their bottom line strained. And so Biden is essentially being forced to address this. So yeah, I think the heat will go up on some of their domestic policy questions. Are you willing to sort of wiggle on this? Remember, he was asked at this press conference, the final press conference in Europe, hey, well, you know, you're at a climate conference. Isn't a price a good thing if you're trying to reduce behavior? In other words, wouldn't high gas prices slow the use of gas? And he really waved that question off. He doesn't want to go down that road either, because of course, you start arguing that high gas prices are good in America, you know, good luck politically.
Josh, thank you, sir. Josh Wingrove, always doing his job. I know that, Josh. That wasn't what I was saying. From New York City this morning. Good morning. Tom Keane, Lisa Bravis and Jonathan Ferro. We're so much ruder in the UK, Tom. You know that, with politicians. It's different here. It's very different, for whatever reason.
You're rude.
From New York, this is Bloomberg.
The energy crisis, there's a lack of drivers. Is there anything that you need to ask authorities to do better, or that your clients want the UK to do better?
I think we're at a moment in time where we're coming out of the pandemic and there are a handful of things going on. I think all over the world there are labor issues that are really a reflection of this transition out of the pandemic. There are supply chain issues. Some of this stuff is transitory. There are some secular trends that we have to watch closely, but I think we're adjusting and dealing with it as anybody else is. And I think leaders here are thinking about it the same way leaders are around the world.
When you look at the UK and, of course, some of these green investments that the UK and the City of London particularly has been really trying to pitch, you've been extremely involved in carbon offsetting. Can London really spearhead that movement?
Well, I think it's important that governments around the world partner with the private sector to try to get capital directed toward innovation in a way that we can accelerate the climate transition. And I want to emphasize it's clearly a transition.
5-day winning streak on the S&P 500 coming into Thursday. Your equity market once again with a lift. We advanced 7 points on the S&P 500, up a little more than 0.1%. On the Nasdaq, 8-day winning streak on the Nasdaq 100 into today. This Nasdaq keeps breathing fire, Tom. Up another third of 1%. A lift again on the Russell, up a quarter of 1%. There is a lift again. All-time highs, record highs across the board through the equity market. Switch up the board and get to the bond market, 2s, 10s, and 30s. We opened up the Thursday after the last Fed decision, September 22nd into 23rd, at around 24 basis points. I don't think that was pushback from Chairman Powell yesterday. He was opening up next year with a bit of humility, saying, here's our base case, here's the risks around it, this is how we'll respond if things go the other way. This market's still priced in hikes next year, didn't change in the last 24 hours. We go from 24 basis points the day after on the 2-year of the last meeting to 46. In and around 50 basis points, Tom. The story hasn't changed much.
And John, what was great is off the countdown clock, Chairman Powell yesterday was great. I mean, it was so good, and with your humility, it's great that we institute the surveillance data check countdown clock.
Your humility too.
This is so Lisa, humble. Don't you think this is constructive that we have this?
It's terrific.
Lisa, do you sense the humility every time we do this?
We do this. You got 19 seconds.
When I go to speak and it offends you so much you jump in all the time, who's humble here, Tom? Just let that breathe.
I don't know.
Just
the clock's ticking. That's what I know.
I see it. I can see the clock. Are we counting up or counting down? How long do I have to do this? Switch up the board and get to crude or get to the pound, whatever it is. It's sterling. Surprise, surprise. 136.29. Is the clock gone? Is it over?
The clock.
There's a Bank of England decision in about 29 minutes. I'm not going to stretch. Let's get you some movers. We can do that this morning with Romain. Good morning, Romain.
Hey, good morning, guys. Let's start off here with some of the big movers of the day. Qualcomm really moving higher here. In fact, this was the biggest upside surprise that we've seen so far out of the earnings season, at least among some of these larger cap companies here. The expectations were pretty low because of supply chain disruptions. Qualcomm said it really managed to navigate through that pretty deftly here, primarily by farming out a lot of its production amongst a lot of multiple manufacturers. Also said that it has less of a reliance on the Apple iPhone and a little bit more diversification with regards to Android products and non-smartphone products as well. Those shares up about 8.5%. Meanwhile, Roku blamed its big revenue miss on supply chain disruptions. Basically says it can't make enough of these set-top boxes. Those shares down 7.5% here. And then Etsy, which is actually supposed to be a big beneficiary of some of these supply chain issues, missed pretty big here. The third quarter numbers actually were okay, but the fourth quarter guidance was a big disappointment. Remember, this is a company where you have the sellers and merchants are kind of disassociated from that traditional supply chain, so they should have been a beneficiary of that. Remember, last year in 2020, they had a doubling in sales. That's not going to happen this year here. Shares only fractionally lower on the day. Flip up the board here, because I think the stock of the day is actually one that's not reporting earnings, and that's Tesla. This is a stock that hit a record high yesterday here. It's up another 2% here in the pre-market here. It's been on basically a 55% run now, just over the past 4 weeks alone. It's, for better or worse, kind of become a good barometer here of risk sentiment, risk on, if you will, here, a barometer for clean energy, a barometer for a lot of things going on out there here. And a lot of strategists we talk to say this has kind of become the risk canary in the coal mine, saying that if Tesla does well, you could kind of get a better sense here of how the broader market's going to do. Now, despite the big run-up that we've had in Tesla here, it's not the best performer in the S&P 500 this year. It's up 72%. It's not even the best performing car company out there this year. That actually belongs to Ford. Ford up another % here on the day here. Some positive sentiment coming because of that lineup of EVs. Remember, the stock here on Ford has actually doubled here so far on the year. And the best performing stock in the S&P 500 this year, doing its best to not be the best performing stock in the S&P 500. That's Moderna. Those earnings just came out just a few minutes ago. Shares down 11% right now. The company revising lower its guidance for a COVID-19 vaccine, basically its only product. A lot of concerns here about whether it's going to get a new contract for those booster shots, and more importantly, whether the technology underpinning that COVID-19 vaccine can actually be used for any other business model other than COVID-19 vaccine shots.
Romain Bostic, thank you so much. To the close this afternoon, and of course a focus on John Deere and a lot of their labor challenges as well. We have been focusing on inflation. We do it across all the different themes of global Wall Street. Honored to have Adam Posen with us here earlier, and many others as well. Gargi Chaudhary is with iShares investment strategy at BlackRock, and she has a heritage that is from the trade division. It's very important. John, I think what's so important here about inflation betting is the bet that's made within inflation derivative products. That's inflation, really front and center.
I'm pleased you brought some of this up, Tom. We can talk about some of the products around the story in just a moment, but let's start with the broader theme to start this morning. Inflation expectations didn't shift yesterday, Lisa. The market has now established what it thinks about inflation and what it thinks what the Fed will have to do. A lot of people defined Chairman Powell's news conference yesterday as a success because there wasn't much disruption in markets. It's really the market response that defined that success. Equities all-time highs, yields didn't move much, okay. But Lisa, for me, it's still a market pricing in hikes next year and a Federal Reserve that's split on doing just one at the back end of next year. So this market's still where it is, and the Federal Reserve is saying, here's our base case. I think the base case of market participants, if you just look at the consensus view captured in markets, there's still a spread there, Lisa, between where the Fed is and between where markets are priced.
What I find fascinating is that markets are convinced that this is something more than the T word, that this has more persistence when it comes to inflation. And even when it comes back down, it will be at a higher rate than pre-pandemic. And the Fed is convinced the other way. And that divergence continues. And the Fed is allowing that divergence to continue by saying, we could be wrong.
What is the bet? And you two are better at this than I am, but I see the real yield, folks, stunning, a negative 0.99%. There's a residual as defined by the real yield. There's break-evens, there's tips, and the rest of it. And these are all being bought on the inflation bet. Is that bet overextended?
More recently, the story has been an inflation story, Tom, for sure. And what you pick up with real yields, I find compelling too, because what we've done over the last month, the last 2 months, is price in tighter monetary policy potentially, and I use the word tighter loosely. To be more accurate, we're pricing in hikes, but ultimately financial conditions are still loose, Tom. And that's captured. The story in the equity market tells it pretty clearly, doesn't it? All-time highs, record highs, record highs.
For a brief visit this morning, Gargi Chaudhary again joins us with BlackRock. Gargi, what is the bet now on the trading desks on inflation? Where is the overextension or the speculation that you see?
Good morning, Tom. Good morning, Jonathan and Lisa. Great to be here. So when we think about what's been happening in the inflation markets over the last few months, I think the market has been, especially the front end of the inflation curve, has been pricing in for a period of inflation that's going to be with us for a period of time, which is longer than just short-lived, as Chair Powell described yesterday. We're definitely seeing a lot of interest in the front end of the inflation-linked bond market. I would say we're looking at STIP, which is shorter-dated tips in ETF, getting a lot of inflow.
But this is critical. I don't think there's enough talk about this, folks, in the media, and Gargi, you're expert at this. Do you look at it as an excess and speculative, or is it normal markets with liquidity?
It is absolutely normal markets. I think the markets are pricing in inflation, which is going to be with us for some time. I wouldn't call this speculative at all. Investors all across the spectrum, whether you're institutional or whether you're wealth, are looking for ways to preserve their portfolio against a higher inflationary regime. And one way to do that within the bond market space is doing so with inflation-linked bonds. So not speculative. This is definitely a hedge in their portfolio for higher inflation, which, and by the way, the view here is that inflation will be with us for longer than initially estimated, especially by the Fed.
But Gargi, to Tom's very good point, is there an element of people hedging and not necessarily saying we think that inflation is going to be at this rate, but we're earning so much from the S&P, we're earning so much from NASDAQ that we might as well cast aside a couple basis points to bet that this could potentially happen? In other words, is the market expectation perhaps not as accurate as it has been in the past?
I mean, if you look at the 10-year inflation-linked market or the 10-year break-even market, I mean, it's only at 2.5%. If we think about our expectations for where core inflation could go in the medium term, so let's say in the next 3 to 5 years, I think paying for something at 2.5% seems still quite reasonable. It's not as cheap as it was about a year ago, but it seems very reasonable if we believe that we're in a world where we can get somewhat higher inflation, somewhere between 2.5 to 2.75% in the medium term. It still feels quite reasonable, and I think that's what investors are paying up for. And to your point, yes, obviously equity markets have done very well, but investors won't move away wholesale from bonds. So one way to sort of have some positive return in your portfolio, which tips have given them so far this year, up over 4.5%.
Gargi, just real quick here, is there any trade that you find particularly overcrowded that concerns you?
I mean, that concerns me. There are always concerns in the market. I think that even looking at Treasury yields right now, even after the Fed meeting yesterday, sitting at 1.5-ish% on the 10-year Treasury and a little below 2% on the long bond, I feel like that is something, if you're overweight a lot of treasuries, I think that's a little bit concerning. I do think with the fundamentals of the U.S. economy becoming stronger as we go into the fourth quarter, I think that is something that's probably going to reprice higher modestly. So that is definitely an area of the market where we think investors should move away from nominal duration into real duration. But outside of that, I think, equity markets, given where real rates are, and I know you were talking about this earlier, we still remain quite pro-risk at this point of time. So what we recommend clients do is really barbell their value basket with their quality basket.
Gargi, you are fiercely intelligent, and I know we had some technical issues before we got you on. Could we re-establish that at some point down the line and maybe have a longer conversation? I'd enjoy that. Let's make that happen. Gargi Chowdhury there of BlackRock. Tom, just on the inflation story and the amount of inflows that have gone into some inflation protection over at BlackRock.
I go back to 1987 where there was a huge misrepresentation or a underestimation, John, of some of the bets being made. We got to be vigilant about that. What is the speculation right now? Where is the overplacement?
Is it a hedge or a conviction trade, which I think is what Lisa was getting at?
Yeah, she was really strong.
Lisa Brammitz, Tom Keene.
She had some humility there.
Just here to balance things out,
That's good, John.
You're both so humble, it's overwhelming. Coming up, Steve Cheverone, Federated on this equity market from New York. Heard on radio, seen on TV. This is Bloomberg.
With the First Word News, I'm Rishika Gupta. President Biden says his party's election defeat in Virginia shows the urgency for congressional Democrats to pass his economic agenda. He told reporters that maybe the results would have been different if he had already signed the legislation. The president said, quote, "We should produce for the American people." House Speaker Nancy Pelosi is pushing lawmakers to take a vote on the Biden plan. Shares of Moderna are falling. The company lowered its estimate for 2021 coronavirus vaccine sales. Plus, it missed estimates for quarterly revenue and profit. Moderna is vying with Pfizer and BioNTech in a race to lock in orders for booster shots for next year. In New Jersey, Phil Murphy has become the first Democrat in more than 4 decades to win a second term as governor. He survived by a narrow margin that stunned Democrats already reeling from a loss in Virginia. Murphy led in recent polls by as much as 11% over Republican Jack Ciattarelli. He ended up winning by 1 percentage point. And the UK has rounded up about 20 nations to pledge to stop funding foreign fossil fuel projects. But the deal has a couple of key holdouts, that being China and Japan. A statement will be unveiled today at the UN climate talks in Glasgow. The agreement isn't binding, but it marks a further tightening of the flow of money from public development banks to oil, gas, and coal. China's Lenovo posted quarterly profit that beat estimates. The world's largest personal computer maker edged rivals in a market that's showing signs of cooling. Lenovo says it expects the global semiconductor shortage to last until the middle of next year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
Just finishing what you were saying, Tom.
Thank
November
you.
3rd is when the decision is. Just in case people got
confused, I will. Just one more story, Tom.
Yeah, thank God for that.
We're at 137 right now.
Wrap it
into
up.
weakness. Is this where they play the music and the Academy Awards? Is this it? Do I thank my mum again? Are you in charge of this?
Is she the only one?
Kill the music. You know who's in charge here.
From New York City.
We're here in London, in Sydney.
In San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims
How
front.
are you thinking about those dynamics?
Do you see Deutsche Bank ready to pay more and pay out more in terms of bonuses for staff to have that strong talent that I'm sure you want?
Well, look, it's a war for talent. It has been, in other cycles before. It is now. We're finding that we're competitive in that war for talent.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
We clearly are setting ourselves up for a policy error. There is no way that we have engaged in the scale of asset purchases in the pandemic where there is going to be a policy which ultimately is going to be perfect and not cause some sort of interruption to asset prices or something else that would be destabilizing.
So far, so good. Scott Minor's not alone, though. The Guggenheim CIO there, and what happens when the Fed pulls back. From New York City this morning, good morning. Tom Keene, Lisa Bravitz, and Jonathan Ferro. Your equity market all-time highs on the S&P 500. Equity futures up another 6, advancing a little more than 1/10%. 5-day winning streak on the S&P into Thursday, 8 on the NASDAQ. We just keep grinding higher and grinding out all-time highs too. Yields in, Tom, 3 basis points on 10s, 157.35. Caught up with Bob Michael at JP Morgan Asset Management, Tom, going into the decision. I said to him, is tapering tightening or not? Is tapering tightening? And he said, John, there will be a price to pay. You can't just pull back. And when we pull back, even though we'll be expanding the balance sheet still and all that good stuff, Bob's message is simple. You will feel the move from 120 down to 0.
Well, John, I love, when you plan the show, John, I love that you selected Scott Minerd there. And what was so important within his caution is there was a point there where he said he's fully risk on. And I think to a lot of our viewers and listeners, that's important. Here's a guy with all the caution radar up, and yet he's in the game.
Keep dancing.
That's
Isn't that something
very
we talked
different.
about yesterday?
Yeah,
Tom,
it's
and
very
when you speak to Scott, you're right. The prospect of a policy mistake, the prospect of a recession in several years' time. But when you hear someone say those things, you have to ask them, okay, if that's going to happen, what are you going to do tomorrow?
Yeah.
And the answer you get, Tom, is they'll still stick with this equity market for the time being.
Yeah. Well, speaking of this equity market, and there is no alternative, Tina Wilson joins us right now with Bloomberg Stocks. Tell us about a group today, which I guess I shouldn't be surprised is up 200%.
Absolutely. What we're talking about are the staffing companies, you know, the ones that get involved.
Ferry, Hedrick & Struggles, and the rest.
Absolutely. I mean, you see so much in terms of how the job market is difficult for companies in terms of their ability to hire. It's been great for these staffing companies, and it's something that Sean Darby over at Jefferies was pointing out in a report this week. So it prompted me to take a look at the group broadly. So we're talking larger, smaller, mid-sized companies. And if you look at an index that tracks them, it's tripled since the lows of March of last year, while the S&P 500 has doubled over the same period. It's been one of the best performers in what they call the S&P Composite 1500 Index.
Bring it over to them as $2 billion revenue companies. These are true small caps. You're the only one in the building who's experienced a small cap boom. Would you say in all the reading you see from Jefferies and others that people are calling for a continued strength in small caps?
Well, I mean, in terms of where they are now, you look at the Russell 2000, it hasn't kept up with the S&P 500 this year. So there's room for recovery, arguably, by that standard. But yes, strategists are certainly pointing to the smaller companies lately as a potential strong part of the market. I mean, given the fact that they really haven't performed all that well. And, you know, if the economy is able to sustain its growth to the point where it doesn't need the support from the Fed, I mean, you figure it would benefit companies across the board, and smaller companies arguably have more to gain from that scenario.
I'm so glad, Dave, that you focused on the staffing firms. And the reason why is because equities discount future growth. We're not just looking at staffing shortages now. What kind of a growth are we looking at? Are we discounting in these shares given the gains? What does it imply in terms of how long these staffing shortages are likely to last?
Well, it tells you the business is going to be good for a while. And you look at numbers like what the National Federation of Independent Business puts out on how difficult it is in terms of their monthly surveys for companies to hire. I mean, it gives you a sense that what we're seeing now is going to be relatively long-lasting, and so that works to the benefit of companies that help businesses fill those jobs, and that's where you find the staffing and employment businesses, and we've seen the benefits already. So Darby would certainly argue there's more to come.
But the interesting aspect is this kind of goes in the face of what we heard from Jay Powell yesterday, where he was talking about how the labor market is has a lot more slack than a lot of people seem to perceive. Is this basically a contradiction to that? People on the equity side of things saying, not really, that actually it's pretty tight, it's going to stay that way for a while, and the shift to power for labor is going to remain.
Well, certainly it suggests that, shall we say, the body in motion remains in motion, and in the sense of how difficult it is for companies to find workers. Now, you can talk about slack all you want, but, when you see numbers like what you see out of the NFIB, I mean, it's clear that on the ground, companies are having issues in terms of finding workers. I mean, we'll get a real sense in the next few weeks because you have all this holiday hiring going on at the likes of Amazon and FedEx and UPS and retailers. So, that'll really kind of be another flashpoint, arguably, in terms of companies' ability to hire workers.
Hey, Dave, looking forward to the coverage through the day. You and I will catch up a little bit later once this market gets open. Dave Wilson there, our stocks editor. Honestly, TK, all-time highs in the equity market, up about 5 or 6 points. 7 minutes from now, a Bank of England rate decision, Tom.
What's
just
the so
around the
what
corner.
on? John, seriously, to our American audience not tuned
They
in,
might hike interest rates. If you still consider the central bank in the UK, Tom, to be a major central bank, they may be hiking interest rates.
You are actually saying there's a probability here they will hike rates in this environment?
I'm not saying it. I'm going off the words of Hugh Pillar, the Bank of England, the chief economist, who called this one a live meeting.
What do the streets say?
Split.
Okay.
Square Mile right now is split on this. The market, in terms of rate pricing, has been pricing it in. It's a 9-vote MPC, 9 officials. Look to see how divided that is. Do we get a 5-4?
Do we know where Governor Bailey is? I mean, this guy's a bright guy.
He has flirted with the idea that we have to tighten monetary policy as well. And I use the word flirtation actually deliberately, because in the past, this Bank of England has been what's considered, Lisa, to be an unreliable boyfriend, flirting with the idea of doing things, but ultimately not following through.
Why do you go to Lisa on unreliable boyfriends?
Really, Tom, you really want to go there? I'm going to divert away from that right now and go to what we heard from Adam Posen, the idea that perhaps the Bank of England has a very different picture that it's facing than the Federal Reserve. Basically, Adam Posen saying the Federal Reserve should not hike rates at this point, seeming to say perhaps it's different for the Bank of England because of Brexit.
Yes, but also consider there is a 6 handle expected for UK GDP next year.
It's a better scenario.
Robust.
Yeah.
Really? I didn't know that, John.
Pretty robust growth. It was in the forecast that we got from the OBR in the last week or so, the Office of Budget Responsibility.
Did you say 6% inflation-adjusted GDP?
GDP.
And to our audience, to be clear, that's remarkably different than what we sense in the United States.
A pickup in growth in the UK. The problem is, I think a lot of people think that they may be responding to all of this maybe prematurely because what might happen with inflation down the road, what might happen with the currency, trying to establish some credibility with the FX market. What will interest me is what happens at about 8:01, so in about 6 minutes from now. If we get a decision to hike interest rates, how does sterling respond? Does sterling rally or does sterling sell off the back of that? And that's kind of the intriguing moment we're in this FX market, Tom.
Do you look at euro sterling or do you look at cable sterling dollar?
Based here with a personal bias, I'll be looking at cable, Tom.
Okay.
What's your entry point?
I just wanted to show that, you know,
Totally.
with a little humility, I wanted to show I actually almost understand.
We make this too personal sometimes.
We get Christmas presents depending on where cable
No
is.
services this year, no goods.
John, at
Services.
Heathrow, Terminal 5, I kill it on sterling.
Already
What are
paid
they?
for. We'll talk about it later. Futures up a 10. Bank of England next. This is Bloomberg.
хорошо подготовлены, насколько это было возможно за столь короткие сроки. Это на самом деле эксперимент. Поэтому мне не хочется употреблять такие слова, как страх, боязнь и все прочее. Мне хочется говорить, что это очень волнительно, но одновременно и радостно, потому что, ну, вы же понимаете, как мало людей вообще там были. А у нас есть возможность полететь в космос, и не просто полететь в космос, а сделать там то, что мы умеем по-настоящему хорошо делать на Земле. Это снять кино.
Тоже это не просто, в чем дело-то. У нас же экспериментальный во многом этот проект. Поэтому мы сейчас столкнемся с кинематографическими нюансами, которые мы могли предвидеть отчасти, какие-то, наверное, не могли предвидеть. То есть, несмотря даже на то, что, опять же, все делились с нами там космическим опытом и так далее. Но это опыт, это первый раз. Ну, то есть второй будет проще.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
As the pandemic fades, will job restoration accelerate? Will a tight labor market push wages up?
I don't think we've ever had a hotter jobs market.
Tune in for the October Jobs Report Friday on Bloomberg Television and Radio.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think the narrative on inflation is a little bit confused.
Year-on-year comparisons are really difficult to do because we are emerging from this extraordinary period.
That second derivative is telling you that perhaps the peak in inflation is over.
Our viewpoint is that it is a glass half full environment.
This is an economy that's still primed for growth.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. The Federal Reserve yesterday, there was no dissent. And John Farrow at the Bank of England, not a surprise, there is dissent.
No change on monetary policy. If we can get my microphone turned up and activated. Tom, 7-2. The vote on interest rates, 7-2. 2 dissents on rates, so they leave rates unchanged at 0.1%. On asset purchases, also some dissent on that. Catherine Mann, Dave Ramsden, Mr. Saunders voting to end asset purchases, but things unchanged, Tom. Beneath the surface, though, some dissent.
Well, this is beneath the surface, and I want to go there. I know, John, you're going to bring in our expert on this in London, Guy Johnson, but Guy, Bond. This is really important.
Can we start this hour again?
Listen, 3, 2, 1, go. Good morning on radio and television. John Farrow, what is so important here is sometimes beneath the surface is invisible. Will we get more visibility today from Governor Bailey?
We've got to hear from Governor Bailey because the guidance coming from the Bank of England is that the rate will have to rise over the coming months to meet the target. So what you've got is some dissent in the early part of this conversation. But ultimately, Tom, they are setting us up for a rate hike at the Bank of England. It's just not happened today. 7-2 the vote.
We've got to go to sterling here. We're going to do the data check real quick. John, I see sterling cable 135.79. I'm going to call it in fractionally. Are you with me on that?
Yeah, cable coming in a bit, Tom, down 0.8%. Cable 135.80. Look, I don't want to say we're lower because we haven't hiked interest rates. We might be lower because they're about to hike interest rates, and that's been a confusion around cable at the moment, Tom. Sterling initially weakened off the back of a conversation on higher interest rates because there was a worry that the Bank of England would hike prematurely. This is the response, though, to both the vote and the guidance and the decision. Do with it what you will. Cable, Tom, 135.77.
They are, and you know, again, the headline here, I love this, John, it's a new word for me, dissipate. It's so British that inflation
will dissipate
over
Does
time.
that work for you? Better than transitory?
It does. Guy Johnson with us in London here. John, bring in Mr. Johnson, please. He's better at this than I am.
Good morning, Mr. Johnson. What are you noticing from this decision?
So this feels to me like, John, they're trying to get the ducks in order. They're trying to get the message sorted out. They're trying to get the sequencing sorted out. I find it interesting that people like Catherine Mann, who's just joined the Bank of England's Monetary Policy Committee, pushing the idea that maybe we need to cut the QE program and then maybe start thinking about where the rates are going. I think it's just a sequencing conversation. I think there's also just a little bit of pushback in terms of market pricing. It would have been interesting to see kind of how the message would have been received if they'd hiked rates and then basically kind of said, you know what we need to do here though is kind of manage the message going forward. We think inflation is going to come back down. We think it's going to get back down to target. So the message still feels very confused, but I think they're trying to sort it out, John.
Catherine Mann voting to end QE, Guy. This is expected to end in a month. What do you make of that? That seems kind of bizarre to me, Guy, that we'd have a vote just 7-2 on rates, and then we'd have an extra vote in there to end QE prematurely by just a single month.
Yeah, but this is the point. I think it's about getting the ducks in order, getting the ducks in line. Because you could find yourself in a situation where you're hiking rates but continuing with QE. Do you want to do that way around, or do you want to do that the other way around? It's a bit like the Fed. At the moment, the Fed messaging is very clear. We're going to do the taper, and then we're going to raise rates. Now, at the moment, the market's got kind of tapering, and then rates start going higher. In the UK, it just feels a little bit more confusing. So maybe there needs to be a more clearly defined message on the sequencing of how the QE ends, the tapering happens, and then we get onto the rate narrative.
This is really important, folks. This is what it's about. I thought this would be a snooze, a sleeper. It's not. John, let me frame Catherine Mann. And really, John, it's almost the idea of Catherine Mann is Fed chair. Think about that. This is an MIT professor who is absolutely definitive within international economics. She's done the rarest of rare, John Farrow, not once on trade deficits and their sustainability within our system, but also on the dysfunction between America and China. She's hugely acclaimed in academics.
I just want to line up December for you now as well, Tom. So on December 15th, you'll have a Federal Reserve decision. Might not be too consequential. On the 16th, Guy, you'll have the ECB with a big decision to make about asset purchases, and you'll have the Bank of England then as well. I think, Guy, you've laid it out perfectly, and I say that as a good friend of yours as well. This is about getting the sequencing right and teeing us up. Do you think December 16th is looking pretty good?
Well, that's certainly the message that I'm getting from this. The implication from what they're saying is that rates are still going higher. We're just not doing it this month. And I think there is communication as a subtext to the lack of a rate hike today. It's about trying to manage the message for the markets. It's about trying to get everything lined up. And I think that's what they're trying to communicate here. There is clearly a desire, judging by the messaging we've been getting from the Bank of England. The governor has led it. Others certainly have been at the forefront of it. Michael Saunders, formerly of Citi, of course. But I think that they're just trying to get everything lined up. And it feels like a rate hike is coming. We're going to go from 0.1 to 25 basis points. That's the expectation. It was finally balanced today. I think it becomes more of a clear-cut decision when we get to December. Remember, also, we'll get more labor market data by then as well. The end of the furlough scheme, we're just starting really to understand the implications of that. They'll have a little bit more information to be able to manage that labor market story by then, too.
Guy Johnson, thank you. I thought this would be boring. I was totally wrong, folks. Really, really interesting. John Farrow, 2 standard deviations on sterling on cable is right where we are, 135.49. So we get a little tension in the market.
Sterling's been confusing, though, Tom, over the last couple of months. I'd look to the front end of the gilt curve right now, where 2-year yields are coming in 7 basis points to about 60 basis points. And because they've ducked this one, Tom, there will be people asking, will they duck December as well? You are conditioned by your experience of an individual central bank, and many people have been conditioned by a Bank of England that flirts with doing things like this and then never quite follows through. Do we really set ourselves up for a move in December? And that's going to be the conversation through this morning and through the next month.
Never a dull moment, and Steve Chiavarone knows that. He is with Federated Hermes. We're thrilled he could join us this morning. Steve, have you guys changed your asset allocation or wisdom across the capitalization view from large cap, obviously a Federated heritage, over to mid cap and indeed the small cap juggernaut we're on right now? Has there been a Federated shift?
No, we've been pretty consistent, being overweight cyclicals amongst the large caps, being neutral to overweight small caps, having some preference for international. And quite frankly, Tom, there's nothing that I heard yesterday from the Federal Reserve that would change our thinking. We think you still have an environment where it's risk on for the time being.
Is there a risk here, as we talk about sequencing, that all the central banks in the developed world all push back rate hiking and, frankly, tightening policy until next year, until the data becomes indisputable, that we get a sort of collective tightening that really puts the brakes on a rally?
Yes, I think that's absolutely a risk. And I think that, it was interesting you were talking about the BOE and sequencing. In a very rare move, the Americans were more subtle than the British, but I think we were doing exactly the same thing. The 2 takeaways from yesterday from the Fed, from my perspective, were humility. They recognized and admitted that they've had a misread on inflation, and then optionality. By saying that they would take the opportunity to vary the speed of tapering, come January. I think what they're saying is that if inflation continues to come in hot, and we think it will, because we think that they're misreading the labor market here, that they would speed up that pace. Well, why would they do that? So that they could start rate hikes earlier. And I thought it was very telling when Chair Powell had the opportunity to push back harder against where the market was pricing in rate hikes for next year. He didn't. And admitting that we could get to full employment by the middle of next year suggests that the market's not crazy in thinking about rate hike number one in June or July.
So I'm looking right now at the fact that two-year yields in the U.S. are moving lower in sympathy with two-year gilt yields. And I wonder how much some of the central bank world is interconnected. In other words, the rate market will move collectively or it won't move at all. How much is that the dynamic that we're in right now for the developed world?
Well, I think it makes sense because I think the inflation impulses are similar. I mean, they certainly are connected to what's going on with the pandemic and the supply chain shortages that are part of that. I think in the United States, the labor market's tighter than it is in other parts of the world and will remain so. But I think the drivers are very similar, Lisa. And so that's not unexpected.
In the perfection of federated Hermes, Steve, there's going to be no window dressing. But to the end of the year, there's a buy-side sweat. How big is the sweat this year?
I think there's sweat because I think folks have been on the wrong side of a lot of trades.
Yeah.
And I think you're going to have momentum into the end of the year. You know, my take from the Fed is equities are going to really like the patience message. I think in terms of Washington, we've defanged some of the most, or potentially some of the most disruptive policy options. We'll see. And so I think you can have a scenario where, you know, kind of like 2013, you've got a real strong finish at the end of the year. And it's been hard to stay with it because as constructive as we've been, you know, you'd have to have been blind not to see some of the risks that have occurred. So I think for folks that have been in our camp, which is to say the fundamentals are positive, respond to bad news if it happens, don't anticipate it and get caught off sides, you're fine. If you've been a little bit too reactive too early, you're going to be on the wrong side of something I think that's going to be quite positive between now and the end of the year, and you're going to try to window dress and catch up.
Steve, just real quick here, what's the bad news you'd respond to?
So I think you got to look at what policy comes out of Washington. If there's something really disruptive there on the tax or the spending side, I think what it really comes down to, Lisa, is we are in a heightened risk of dual policy error, either on the monetary policy side or the fiscal policy side. We've never spent money like this after an economy is at full capacity. We've never been this reactionary to inflation rather than anticipatory. And both of those things may be fine, but we don't know. So I think you've got to have humility. And quite frankly, it was really good hearing the Fed say that they're having some humility as well, because we are in uncharted waters on both monetary and fiscal policy.
Steve, thank you, sir, for your humble opinion on this market. Steve Chevron of Federated Hermes. Steve, thank you, buddy. Good to see you. Lisa, that's the moment we're in. The wide range of outcomes through next year. We've had some great interviews so far this week already. It was Frances Donald that called it the anti-forecast for next year. That. I'll be interested to see what her research looks like into year-end, into the outlook, into next year.
What's the balance of risks, to use Federal Reserve language? I think the Bank of England rate decision is fascinating because they pointed to the slowdown in growth that they experienced over the late summer, the idea of the Delta variant. I do wonder whether deferring rate hikes means fewer of them or just simply concentrating them more when the data is more clear.
The growth outlook has weakened since August on supply issues. It was Adam Poston that talked about the lack of flexibility around some of those supply issues, particularly in the UK. Some unique circumstances there, perhaps, Tom. But more broadly, if these central banks make a move, are they making a move into a weaker economy? And that term weaker, Tom, is relative. Because if we're talking about 4% GDP next year in the United States and 5 to 6 in the UK, you'd take 5 to 6 real, wouldn't you?
In the summer, John, we were migrating a vector to what? 3%, 2%, sub-potential GDP. That's out the window. We don't know where the x-axis is. I really have trouble right now with the Fed parlor game. I'm focused on what corporations are doing. Becton Dickinson today with a major buyback. They've been struggling. John, it's buyback nation.
The earnings are looking good as well, Tom. Up a tenth, call it 0.2% on the S&P. All-time highs in America. This Thursday morning, good morning. This is Bloomberg.
Radio.
We are on the verge of a disaster.
Join us live from Glasgow for coverage of the COP26 Climate Change Conference.
People are beginning to build some momentum, I think. The question is, will it be enough?
We'll speak with global leaders, keep you up to date on progress and setbacks, and analyze what it all means to you.
We're going to need to see some real action.
COP26, the UN Climate Change Conference, this week on Bloomberg Television and Radio.
How much stress is there at the moment amongst the asset managers that actually some of the ESG labeled products, then if you probe, are not green?
Well, look, there is some stress, and it's great that there's that scrutiny, and there's that skepticism or healthy skepticism about ESG labels or sustainable labels. And that, again, is one of the reasons we're having this ruthless, relentless focus on net zero, because in the end, look, we can't stabilize the climate unless we get to net zero. And it's as simple, these are hard numbers. Your emissions are either A or B, they're going up or down. And if they're going down, are they going down consistent with the science? We anchor it in the science, the same science the UN and others use for the 1.5 degree objectives.
Should this not be compulsory? Should we not have regulators coming in and saying, look, this is a new definition, you stick by it, and we're going to measure it?
So I think it's a great question. So let's look at what happened with TCFD, climate disclosure. 6 years ago, you and I were in Paris. We talked about this. We talked of other things. Now that's moving to become mandatory.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
The Federal Reserve is making a choice to really strive to find the maximum level of employment consistent with their inflation objective. And by doing that, there is a risk that they're going to be late. The key thing, though, at the end of the day, is not whether the inflation pressures are transitory or not, but does it get into wages and does it get into inflation expectations?
In just a moment, if we get the microphone on, there it is. Bill Dudley, Bloomberg opinion columnist, senior advisor to Bloomberg Economics. Your equity market.
John, my fader, I did
points
that. That was my fault,
the S&P
John.
500. Are you in charge of that, Tom?
Yeah, I'm in charge of that.
Up 2/10
Pharaoh
of
fader
1%.
button here.
Keep it down, Tom.
Thank you.
Just turn it off for the rest of the morning. I'll go home. Yields lower by a couple of basis points on 10s to 157. Big move at the front end of the yield curve over in the UK. 2-year yields come in 9 or 10 basis points now to about 57. And cable's down about 1% off the back of this. They teed us up for a move today. They called it a live meeting. It wasn't the media, it was the Bank of England. It was the chief economist, Hugh Pill, who called this a live meeting. And then only 2 voted for a rate hike. 7-2 the vote. It's on to December to see if they move then, Tom.
John, I'm sure your family in England, I say this with great respect to the Farrell clan, the larger Farrell clan, remembers the 20s and 30s and the difference of the real wage in the United Kingdom. It changed society. It was horrific. And that's the heart of this, is Dr. Dudley mentions, is this folds into wage. And really, John, forward into next year, that's going to be the number one thing, is wage growth and inflation-adjusted wage growth.
Yeah, and Tom, is the price pressure getting broader, not narrower? And are some of the factors behind it less temporary in nature? You could speak to people like Mohammed Al-Arian who would say, yes, it has got broader, Tom. And yes, it is getting more persistent.
Well,
not less temporary, not more temporary, rather, and certainly not narrower.
You know, I come up with big things like chart of the year and all that other stuff. John, I'm just going to say the theme next year is going to be real wage growth. Let's do this. Ira Jersey with us on the short list with Conte to take over the TOTS, and he joins us right now. They didn't go with Jersey, but it was considered at one point. Ira, on the bond market, and Lisa and John are going to drive this. What caught your attention yesterday that changed your short-term paper view?
So not much changed from the Fed's view, because the taper happened exactly like we thought. And, Jay Powell, I thought, was a little more dovish than maybe we could have expected if they were really worried about inflation. And, Chair Powell tried to stay really balanced. But I think what you saw this morning, what you guys were just talking about with the Bank of England, basically saying this was a live meeting and then not hiking yet. Although kudos to Bloomberg Economics' Dan Hansen, who, had called it that they were going to hike in December and not now. It's basically, you still have this push and pull where economies aren't good, and you're talking about real wages. Real growth is actually slowing in large part because of the higher inflationary pressures. So the question is, will the Fed and other central banks start hiking to slow the economy because supply chain pressures are forcing certain things higher? And President Dudley is right that, look, is this going to feed into wages? Is this going to force companies and individuals to demand higher prices from their consumers? And that's, I think, still an open question, and will be into the second quarter next year.
Okay, it's going to be second quarter next year. John, pick it up here. I think this is just so important. These nuances, given the liquidity and the declining savings rate, John Farrow, are absolutely critical.
He gave us a timeline, and that's what's fresh about yesterday. Lisa, he gave us a timeline to play with, the second quarter or the third quarter next year. And Lisa, what I find remarkable about that is that we've moved the goalposts so much. Vice Chair Rich Clarida was on this program 6 months ago and talked about the importance of the turn of the year. When I asked a very basic question, how would you know if you're wrong? We'll find out perhaps around the turn of the year, into the new year. I'm paraphrasing, but you can go back and watch the interview. That was the guidance we were given. Governor Waller was talking about the next couple of months as a threshold, a benchmark, to really rethink the transitory story. And Lisa, here we are. And look, it's up to the Fed to do what the Fed does, but here we are with the Fed saying, I'll see you in the middle of next year.
Yeah, and I'm curious what the message is really that the market is sending, right? And I wonder, Ira, if you could comment on this, particularly with respect to negative real yields. The idea here, is this a sense that it's because of the savings rate, it's because so much liquidity has been pumped into the market, it's because of a really accommodative Fed, or is this because the market believes that there will be slowing growth, a disinflationary environment that's going to be challenging in the near term?
So I think the real yield story is several-fold, but one of the big ones is that the Federal Reserve, when it was doing quantitative easing, and still is and will be for the next 6 months, they're buying more than 100% of supply. Meanwhile, you do have a lot of people who are worried that inflation is going to keep on rising. So when you look at flows into TIPS, mutual funds, and ETFs, people looking for an inflation hedge, that has completely overwhelmed the TIPS market. And that's one of the big reasons why you have real yields as low as they are. Negative 1% for 10-year real yields is not completely unprecedented. That happened a few years ago, but it's the fact that they've stayed there for such a long period of time, I think, is endemic of just the idea that people want inflation protection, and they'll almost pay anything in order to get it, even if it's at unreasonable prices, like well above par or at negative interest rates in terms of real yields. But so you have to have a lot of conviction that you think that inflation is going to be high for a long period of time in order to buy a lot of these Treasury inflation products.
Ira, this is a fascinating and super important point, especially as the Federal Reserve potentially gets deeper into its tapering program. If there comes a point where they are buying less than the Treasury is selling, do we get a reckoning? What does that reckoning look like?
Yeah, well, our models suggest that fair value for 10-year TIPS yields is more like negative 50 basis points as opposed to negative 100. So you could have a pretty big sell-off. And then the question becomes, during that period of time, if real yields do rise, say 50-ish basis points, then the question is, do you see nominal yields rise and inflation expectations stay the same, or do inflation expectations come down? One would expect that if the Fed gets more hawkish and as we get closer to an actual interest rate increase, whether that's September next year, which is what the market's fully pricing at this point, or even if it's December, but as you get closer to the Fed liftoff, I suspect that you wind up getting inflation expectations, particularly longer-term inflation expectations, start to come down. So you're still in an environment where real yields up, inflation expectations down, maybe nominal treasuries don't move a whole heck of a lot in that environment.
Ira, great to catch up, sir. Ira Jersey, fantastic, brilliant, fascinating stuff on this bond market. In about 5 minutes, you'll hear from Governor Bailey in a news conference over at the Bank of England. Lizzie Burden, our reporter out of the UK, asking whether the unreliable boyfriend is back on Threadneedle Street at the Bank of England. I think in fairness to the BOE, Tom, if they want to tighten interest rates and they want to hold your hand and guide you towards doing that, to get the sequencing right, and Guy really explained this very, very well, QE ends at the end of the year. If you want to hike interest rates, just in terms of the sequencing, it makes sense to wind that down first, then hike interest rates, make sure the credibility is intact. The problem is we've been conditioned by the Bank of England perhaps bluffing in the past and not following through, and that might explain the move at the front end of the curve this morning.
This is great, folks, because I thought this was a snooze fest. I was totally wrong. Bank of England surprises, period.
Gets a little bit more interesting. Ed Yardeni's going to join us soon. Yardeni Research President from New York City, on radio, on TV on this Thursday morning. Good morning to you all. This is Bloomberg.
The 700th anniversary of Dante Alighieri's death has triggered the work of many institutions and offered a very rich schedule of events. Today in Santa Croce, we present one of these projects that suffered a difficult start because COVID-19 has stopped the project that was shared by the Opera di Santi Croce by the Franciscan community from Florence Municipality and the Fund for Religious Building of the Internal Minister. Today, Felice Limosani's project is finally enjoyable. In the Pazzi Chapel, the marvelous architecture by Filippo Brunelleschi, the most important images from the Divine Comedy created by the French illustrator Gustave Doré. Through these images, we can live the violent emotions of hell, the weight of purgatory, and the sublime joy of paradise.
The digital humanities are a cultural occasion to exploit. Summing up, it's about merging humanistic disciplines with new technologies. I find this to be an innovating and modern tool to update culture. Cultural heritage becomes something to hand over to the new generations and not to be put aside. So it's about using technology, pixels, and binary code with a human and humanizing content.
I was just finishing what you were saying, Tom. November 3rd is when the decision is. Just in case people got confused, I will. Just one more story, Tom.
Yeah, thank God for that.
We're at 1:37 right now. Into weakness. Is this where they play the music and the Academy Awards? Is this it? Do I thank my mum again? Are you in charge of this?
Is she the only one?
kill the music. You know who's in charge here.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Live from New York City for our audience worldwide on TV, on radio, alongside Tom Keene and Lisa Bravitz. I'm Jonathan Ferro. Your equity market shaping up as follows, with futures up about 7 points, advancing a little more than 1/10% on the S&P 500. 5-day winning streak into Thursday on the S&P, 8 on the NASDAQ. We got some data for you. Let's bring in Mike McKee for that economic data in America. Morning, Mike.
Good morning, John. Let's quickly look at initial jobless claims, 269,000. The trend continues. We're kind of getting back to the way we were pre-pandemic, which is good news. The bad news comes in the productivity statistics. We were hoping that we would see productivity increases as companies tried to invest to get around the fact that we didn't have enough workers, but productivity down in the quarter by 5%. This is the first estimate. We'll get some revisions, but a 5% decline. We had seen a 2.1% increase in the prior quarter. The unit labor cost issue is obviously going to be higher, and it's 8.3% up. That's more than the 7% forecast and certainly more than the 1.3%. So in the third quarter, we did see it cost employers a lot more to bring people back. And finally, the trade balance comes in at $80.9 billion, and that is more than the $72 billion revised number, $72.8 billion for the prior month. This is for September, and we kind of knew this was going to happen because the advance report on trade had come in higher. It does suggest that third quarter growth was even weaker than it came out to be. So it looks like in this case, sort of a balanced picture in the third quarter of some good news on the labor market, some bad news for employers, and we knew the economy had slowed.
It's the right kind of downside surprise on claims, though. That's what we want to see. 269 on jobless claims in America. Labor costs sky high. We expected something like that. In the bond market, yields coming at the front end a little bit more here. We're down 3 basis points on 2s to 43. Let's call it 44 basis points. On 10s, we come in about 3 to 157. Got some dollar strength out there in the mix as well. Cable lower off the back of that Bank of England rate decision. Sterling a whole lot weaker. We go into that Bank of England news conference, Tom, in the next couple of seconds. That sort of started around about now.
Yeah, we'll have to see what those headlines are. And Michael McKee, we've got to talk about unit labor costs within the productivity calculation. I did a quick moving average study. Maybe we saw it in 2013. Maybe we saw it in early 2000 or even back to the 1990s. If nominal unit labor costs are there, what does it mean for policy in Washington?
Well, again, this is an answer I've given a lot of times, Tom, is it's going to depend on how long it lasts. We knew there would be an immediate jump because people were coming back to work, and we've seen the anecdotal reports of how everybody has to offer more money to try to find employees. Do unit labor costs continue to rise once people get back on the payrolls? That's going to be the big issue and the real question for the Fed. I want to point out one thing, if I could, quickly on trade. 21% increase in imports. We've been talking about supply chain problems, but the White House put out a report yesterday that suggested we are processing more supplies than ever before. It's just the demand is so strong that they can't keep up. It's not that we have fallen off, and you can see that in the import numbers for the prior month.
This is very important. Michael McKee, thank you so much. Congratulations for bringing the chairman to silence yesterday. I don't think enough can be said on that, on your abilities over the decades. Speaking of decades, Ed Yardeni joins us right now. Dr. Yardeni of Yardeni Research. And Ed, I just want to get to the inflation story right away. And let's go back to the 70s, even 60s playbook. There is the cost, there is the push, there is the demand, there is the pull. What kind of inflation are we enjoying?
Well,
it does have some similarities with the 1970s. In the 1970s, everything that could go wrong on the inflation front seemed to go wrong. For example, we closed the gold window, and so the dollar took a dive, which then caused commodity prices to soar. Food prices went up. There was an issue with anchovies off the coast of Peru, which somehow had an impact on soybean prices. Don't ask me how that worked exactly, but it did. And then we had two oil shocks, and we had cost of living adjustments. So all those shocks went right through into wages. We don't have cost of living adjustments anymore, but we've probably got the labor movement in control now, more so than ever before. And it's not really a movement, it's just a shortage of workers. And so wages are going up. And I think the supply disruptions explain why productivity took a dive there in the third quarter. But I think companies are already responding anecdotally anyways to the labor shortages. They're going to be chronic. And I think we are going to see a tremendous amount of automation.
Do the mere mortals at the Fed risk a policy error?
Well, they are mere mortals, so we got to start. We got to start with that insight, which you correctly point out. But I think that there's sort of a view out there, which I share, that they are behind the curve, contrary to what the Fed chair has been saying. The economy's done awfully well, certainly in the first half of the year, and second half, it's the supply disruptions that we don't want to see the pressures on the pricing inflation side go into wages. So I think they're a little bit late, but look, my job isn't to tell the Fed what to do. It's just to anticipate what they're going to do, and what they're going to do is taper, as we all know, and they're probably going to stick with it through the middle of next year. And then I actually will not be surprised if they raise the inflation target from 2% to 3%, because it's going to be an even more liberal, more progressive Fed next year. The way I see it.
Wait, hold on a second. Can you elaborate a little bit on that? Because that's a point that Adam Posen has made as well, that perhaps they're not going to try to fight higher inflation on a base level, but rather embrace it. What will sort of trigger that shift in mentality?
Well, I think the Fed's going to have to at some point concede that inflation is not transitory, but it is persistent. Right now, what they're saying is that the supply chain disruptions are persistent. Well, yeah, so what does that mean? It means that inflationary pressures are going to stay persistent. So I think much will depend on the Fed chair. I don't think it's going to be Powell. I think it's likely to be Brainerd. I think there's going to be a couple of openings that get filled by more progressive kind of people. The Fed is simply going to become more politicized, more progressive, and I think more inclined to say, well, you know what, 2% is too low, 3% is fine, and if it's a little bit above 3% for a while, we can live with it. They really don't want to raise interest rates more than they have to, and they'll move the goalposts.
Okay, so Ed, you mentioned the 1970s, which is basically a trigger for a lot of people watching the bond market. I wonder where the analogies start and where they drop off, especially if you do have a more dovish Fed that is more willing to allow inflation to hover around the 3% level. Are we really heading into a period where inflation could get away from the Fed, or do you think that the Fed can keep control over it, just albeit perhaps at a bit of a higher rate?
Yeah, well, I'm actually an optimist on the inflation outlook in terms of over the next few years. I don't think this is going to be the 1970s all over again. The big difference is productivity collapsed during the 1970s. It went all the way down to zero. I don't think that's where we're heading, notwithstanding this morning's disappointing news or surprising news, whatever it was. But I think productivity is going to make a comeback, and that's an important offset to wages going up faster than prices. You folks mentioned that we're going to be putting a lot of weight on real wages, but I think we want to look at real wages relative to productivity. The only way that real wages can actually go up is if productivity makes a comeback. If it doesn't, then we're going to have a wage price spiral, which was really what the 1970s was all about.
Okay, how do we calculate that or guess that, and when do we do it, Ed? Is that a first half 2022 exercise, or are we that data dependent on rising wages?
Well, at this point, the productivity story really is anecdotal. You know, we can see that companies are scrambling to increase their productivity with robotics, with automation, with artificial intelligence. The good news is the technology is there and is relatively cheap and implementable to make that happen. So I don't think we're going to have to wait all that long. I think by the second half of next year, we're going to see that inflationary pressures abate, partly because of productivity and partly because supply chain disruptions get ameliorated. That's a big issue, is the supply chain disruptions. So I think we're going to have more cars by the second half of next year, more supply, and that could take a lot of pressure off inflation.
The bond vigilantes stay in hibernation then, Ed?
Well, you know, it's hard to for them to have much of an impact when the Fed basically has been rigging the bond market. I mean, they've been so aggressive in that market that it's hard to even call it a market. It's not a free market, certainly. But I think by sometime next year, we'll see 2% on the 10-year. We also have to factor in demographic factors here. In the 70s, we had a tremendous influx of baby boom workers. Now they're retiring, and we're seeing that the growth rate in the labor force is close to zero. The only way this economy is going to grow on a trend basis is if productivity makes a comeback, and I'm optimistic on that.
Good to catch up, Ed. As always, Ed Yardeni, the original man of coining the phrase, the author of Bond Vigilantes. Looking at some of the guidance coming out of the Bank of England, Governor Bailey, Tom, saying recent data reinforces the view that rates need to rise. Going to be interested to see what Governor Bailey has to say once the Q&A starts.
John, I don't know if you've seen this. Jordan Rochester, we're always a big fan of his acute work over at Nomura. He publishes a blistering note here on the delay, the move to December, and Johnny frames out his bet towards 134.50 sterling. I mean, it really, the idea of a less, you mentioned 6% growth. I believe Mr. Rochester is suggesting a lesser growth, weaker sterling.
Direction of travel important. Growth expectations are being revised down. This from Jordan Rochester of Nomura. Mobility and credit card spending is sideways, and real rates in his mind pointing to 134.50. I miss being in the room at the Bank of England, Tom. It's a good time.
Well, yeah, I thought you did a great job in front of the ECB in Frankfurt. I mean, the difference is...
That was colder.
Yeah, it's colder. And the difference is in London, the lunch is an hour and a half, and in Frankfurt, the lunch is 3 hours.
In London, they make you stand outside the Royal Exchange. You know that little point around Bank Station, Tom?
Yeah.
You'd stand there through the morning.
I'm aware of that.
Do hits, reports on the Bank of England, and people would throw stuff at you. Good times. Yeah. They wouldn't, Lisa. It's not that rough. It's not that rough. Emily Rowland joins me next in about 20 minutes from John Hancock on this bond market, this equity market too, and why she thinks your bias should be towards America. We'll build on that. From New York, this is Bloomberg.
With the First Word News, I'm Rishika Gupta. Speaker Nancy Pelosi is pushing the House towards a vote on President Biden's economic agenda, but a few key issues are still unresolved, such as family leave, immigration, and rolling back limits for state and local tax deductions. And the measure still doesn't have the full support of Senate Democrats. The UK has rounded up about 20 nations to pledge to stop funding foreign fossil fuel projects, but the deal has a couple of key holdouts, that being China and Japan. A statement will be unveiled today at the UN climate talks in Glasgow. The agreement isn't binding, but it marks a further tightening of flow of money from public development banks to oil, gas, and coal. Macy's shareholder New Orion Advisors says the department store chain should accelerate its digital transformation. It's calling on the company to partner with crypto platforms to allow digital payments. New Orion also says Macy's should form partnerships with electric vehicle companies and use its parking spaces to build an EV charging network. Nintendo has cut its sales target for the Switch gaming console. The Japanese company blames semiconductor shortages and logistics bottlenecks, which it says show no sign of easing. At the same time, Nintendo upgraded its full-year operating profit outlook, citing currency exchange rates. And Deere is taking a hard line after striking workers rejected a second offer. The farm machinery maker says the latest contract it provided to 10,000 members of the United Auto Workers Union is its best and final offer. Deere vows it will not return to the bargaining table. The strike's now in its third week. Global news 24 hours a day on air and on Bloomberg Quick Tick. Powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
China is a gigantic part of our economic life and will be for a long time, for our lifetimes. But that does not mean that we should be naive in the way that we look at our critical national infrastructure, the way we look at, you mentioned nuclear power, you mentioned 5G technology. Those are all legitimate concerns that any government, many other governments around the world have. But I've said this many times, it's worth repeating, I am no Sinophobe, very far from it. Do
you think you're the last Sinophile in the cabinet?
No, I expect there are lots of... look, China is a great country and civilization.
What about wind power? Would you let them buy offshore wind power? That's infrastructure.
I think you'd have to
railways.
You'd have to look at what was you're defining as strategic or critical.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
From New York City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims front.
How are you thinking about those dynamics?
Han profundizado el extractivismo en Argentina con más agronegocio, con más transgénicos, con más agrotóxicos, con más proyectos megamineros y ahora, como si fuese poco, han avanzado presentando un proyecto de ley que es la ley de hidrocarburos.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
If you take a look at, gas prices, and you take a look at oil prices, that is a consequence of, thus far, the refusal of Russia or the OPEC nations to pump more oil. And we'll see what happens on that score sooner than later.
If it's Tuesday, it must be Belgium. Well, maybe not. I'm sure the president saw the movie years ago. From Rome to Glasgow and now back to Washington and the challenges post-election. The president of the United States. Lisa Bramwitz, moments ago, the president speaks. He gets his act back together after the elections. And this involves something in the order of 80 million plus employees, where I guess we're going to get some very strict vaccine mandate over 100 employees.
Yeah, the idea of federal employees having to get vaccinated. This is an administration tightening the screws. They've been outsourcing some of the requirements to private corporations. This is a shift. There is no option, at least according to what we can see right now, for just testing. This is a vaccine mandate, and you do wonder how much this stems from frustration that more people are just not getting vaccinated.
You wonder how this spreads out across private enterprise. Of course, the uproar over Mr. Rogers at the Green Bay Packers. It's a 100-employee limit, and you've got the Green Bay Packers with 900 employees, so I guess they're into it.
I just do want to correct, there are some options for tests on a weekly basis. However, there will be certain vaccines that will be required otherwise among many of the employees.
Yeah, well, there it is from the president, and we'll continue this dialogue. And, of course, the pediatric vaccines rolled out. Lisa, just quickly here, anecdotally, what have you seen among the parents where we've got this pediatric vaccine?
Well, it depends on which zip code you're in. Some parents say we want to wait and see what the data shows, if there are more people need to get inoculated. And then you've got other parents that say, let's go. I would have done it last week. When can we go?
Right. An unfair question, Lisa, not to you, but to Ellen Wald, Senior Fellow at Atlantic Council, joining us for a brief visit this morning. Ellen, the spread is narrowed between West Texas Intermediate and Brent Crude. Do you just apply within your macro view that Brent will widen out higher, or will West Texas Intermediate come back lower?
Well, you know, one of the interesting things is that WTI has been doing better recently, particularly with foreign buyers, because it was priced a bit lower, and so we saw some increase in exports from the U.S. to China and other countries. If that spread collapses, then the U.S. benchmark may become less interesting to foreign buyers, and that may actually help gasoline prices at home a little bit.
Well, it may help at home a little bit, but are we at a tension point on gasoline? I see it on AAA unleaded $3.40 a gallon. The moving average back at $100 a barrel was like $3.58 a gallon. Or is this time different?
So it does seem that gasoline prices are starting to calm down. We're not seeing as many increases as we were previously. So I do think that we're kind of coming to an equilibrium in terms of gasoline prices at this time. We've got plenty, of gasoline in storage. Some of the recent numbers from the EIA are showing that that crude and gasoline stores are increasing a little bit. So I think that's helped push the numbers down. Of course, if we have a very big demand over the Thanksgiving holiday, that could certainly cause some prices to rise.
Ellen, honestly, the idea that Biden is planning to release some of these stores in the strategic reserves, how dramatic of a response would that be?
You know, I don't think that it would produce quite as dramatic a response as he or his administration is really hoping for. If you look at the global picture in terms of oil, we've got OPEC looking to increase production by 400,000 barrels a day starting in December. Plus, you've got global consumption at about 100 million barrels a day, which is basically where it was pre-pandemic. And so the U.S. could do an SPR release, but refineries are running pretty much at capacity. We've had some declines in the total amount of capacity of our refining since the pre-pandemic days. But if there's a bigger SPR release, that's not necessarily going to translate into more gasoline and lower prices for the long term. We could see a brief push down, but in general, unless it's repeated, I don't think it's going to help all that much in the long term.
Ellen, there's also a question about what President Biden's stance has been toward the shale industry. Is there anything identifiable from your perspective that the Biden administration could do to try to prompt more pumping in the shale patch, or whether that's even appropriate in this type of situation?
Yeah, I think it's definitely a factor in higher oil prices. I know that Biden really wants to blame Russia and OPEC for failing to produce more, but they are actually increasing production at a pretty good clip compared to the U.S. Oil industry, which is not really increasing production at nearly that clip. We heard that there was 11.5 million barrels a day produced last week in the U.S., which is a slight tick upward. It's really not enough of an increase to bring oil prices down. And the Biden administration has certainly made a lot of producers very wary of increasing production. It's not just about investment and the desire for capital discipline. It's also a concern over growing regulations, and the methane rules that were announced earlier this week are not helping things. I do think we will continue to see a slight increase upward, but unless the Biden administration comes out in a big way and says, hey, we want to encourage investment in this and we're going to help the situation, we're going to do what we can to assist in more production, I don't see a major increase in production happening anytime soon.
Ellen, thank you so much. Greatly appreciate it. With the Atlantic Council on Oil. There are moments where you just stop, Lisa Abramowitz, and I did that with the announcement, I believe, off of Dow Jones, that Google will take a $1 billion position in Chicago's CME Group. We should point out they have been sponsors of Bloomberg surveillance at many times over the recent years. Lisa, to me, this is thunderous. This is where you get cloud position by taking an equity ownership through a convertible preferred security. You wonder, how does Amazon, how does Microsoft, even IBM, how do they react to this?
As we move markets to the cloud, what does that mean in terms of the tech giants' power? Who gets in charge, especially since it's been a very much a food fight between Microsoft's Azure and Amazon's AWS? How much does this move Google into the position that perhaps other people had discounted them? I'm just looking at some of the trading activity, thin trading on CME, shares up 5.5%. The more interesting activity, frankly, is Google. You are seeing the shares up on this news. Because people are looking at the potential for the cloud to gain more dominance.
I mean, it's a snark-free Thursday, but would Google invest $1 billion in the United States government if they could get a piece of Pentagon cloud? I mean,
really?
Think about it.
I'm not going to start that rumor. It's snark-free. It's snark-free Thursday, but that's all you need to know, Tom.
It is never a dull moment. Never forget humility and order, as the chairman mentioned. I was wrong on Bank of England. It was fascinating.
Yes.
Stay with us through the day. Red and green, small caps up. I believe John checked me on that. We have a countdown clock now to the open on TV.
His top spot as Asia's busiest airport in 2020 when passenger traffic slumped 88% from 2019. The lack of a domestic market and strict COVID rules have made for a slow recovery, and walking through the airport, the majority of F&B outlets and shops do remain closed. Here in the departure hall, long stretches still remain boarded up in areas where you would typically see throngs of passengers waiting to board their flights to destinations across the world. Only 2 lounges do remain open to travelers, one operated by the Plaza Premium Group and the other by Cathay Pacific, down from the 12 that are usually open here at the airport.
Unfortunately, when COVID had hit, we had closed a lot of our lounges and airport hospitality services. We're cautiously optimistic with the growth.
COVID certainly has forced a rethink of strategy to be nimble in the face of policy uncertainty during the pandemic era.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
You talk about hiring aggressively at the moment. Can you walk me through how challenging that is at the moment? How difficult is it to find the right people?
Well, things have changed. Again, the world has changed under the pandemic, and you all know worldwide, you know, what the challenges with getting people back into the workforce.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield. From New York City for our audience worldwide, record high after record high. Good morning, good morning. Your equity market up 6 points, advancing 0.1%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
From New York, we begin with the big issue. Chair Powell threading the needle.
Look, Powell and company absolutely threaded the needle. Of course, announcing the tapering.
What we heard yesterday is
the Fed is exiting. It took a step yesterday. There's more steps to come.
But this has been so well telegraphed.
The Fed doing a pretty good job at keeping markets calm.
The market was already there.
The Fed, along with the ECB, have tried to, kind of hold the ground.
The chair showed a good amount of humility.
Chairman Powell actually walked the fine line pretty well.
Does the market know the Fed's reaction?
We're getting a little bit of a better picture.
Joining us now is John Hancock's Emily Rowland, Toll Backens, Michael Purvis, and Chris Harvey of Wells Fargo. Emily, let's begin with you, and I'll wind all three of you up. Is this transitory for longer? Emily, is that what it is?
John, I thought we banned the T word on Bloomberg this morning.
Only on Bloomberg surveillance, Emily. This one, it's allowed for the next hour. Go ahead.
All right, so it's allowed. No, we think Powell did a great job yesterday. He was well articulated, very balanced in his comments. And look, it's a huge, uphill battle to have credibility in this environment for central bankers globally. We just had the fastest recession on record. We just did the largest amount of fiscal stimulus in history. And now central bankers are doing the biggest U-turn that they've ever done. And Powell's steady hand here and the market's very calm reaction to the announcement of tapering yesterday, to the acknowledgement that maybe at the margin, inflation appears to be transitory, maybe a little bit more persistent than expected, is really speaking to the credibility of the Fed moving forward.
Michael Purvis, did they just move the goalposts?
Not really. I think, look, when you step back, we had a lot of hikes being priced in over the next 3 years here. So I think to a certain degree, the Fed did thread the needle quite gracefully yesterday. But I also think that the markets had sort of set the stage for that as well. Sort of jumping ahead of a slight more hawkish thing. I think what I'm really focused on right now is there's all sorts of inflation narratives, but the one that I'm focused on is basically inflation is going to be complex and confusing for a very long period of time. And that may mean that whatever hiking cycle we do get out of the Fed may be a very different type of pattern than what we've seen in earlier cycles. And I think that's the thing the markets are going to have to come to terms with.
Chris Harvey, can I get your view on all of this as well?
Certainly. So here's the good, here's the less good. On the good side, what he said, and I agree with it, a lot of the issues surrounding inflation are supply chain related. Raising rates doesn't help that. What helps that is giving it time, and we're going to give it time. So I thought that was fair. I thought that was reasonable. Market reacted to that. That's great. Now what we're seeing today is break-evens are going higher, reals are going lower, nominals are going lower. So longer term, the market is beginning to talk to you and start to indicate, hey, we're a little worried about stagflation, right? Because if inflation expectations are going up and reals are going down, what it's saying is, hey, maybe inflation does eat into growth. Maybe we have to worry about that longer term. But in the short term, he took a lot of the fear off the table. He did tell you, and again, I agree with this, we're not going to raise Fed funds because of supply chain issues. And I think the market appreciated that. But longer term, the market is beginning to worry more and more about stagflation.
He's given us a timeline now. I think that's important. This is from the chairman yesterday on 2022. Take a listen.
Supply chain bottlenecks will abate and job growth will move back up. And as that happens, inflation will decline from today's elevated levels. Certainly, we should see inflation moving down by the second or third quarter. If a response is called for, we will not hesitate. So what I will tell you is we're watching carefully to see whether the economy evolves in line with our expectations. and policy will adapt appropriately.
Emily, he talked about the second and third quarter. Now, the goalposts for me have moved. At the start of the year, if you told me transitory for them and temporary factors was something that started to fade in the second or third quarter of 2022, I think we've had a very, very different conversation. We would have had a very different one earlier this year. The second and third quarter, for me, Emily, they've set up the reaction function. They've said, plug your forecasts into it, and if you think we're wrong, this is what we're going to do. What's your view on that, and do you think their forecasts are wrong?
You know, I think we've all had to have a little dose of humility here in terms of making those forecasts. And you referenced Francis Donald, my colleague earlier, who talks about the anti-forecast heading into next year. And, you know, we've revised our expectations around inflation and pushed those out a quarter or two into next year. I thought it was interesting that Powell was explicit around that. Look, I think the one thing to kind of think about here is central bankers have been wanting inflation for over a decade. So I wonder if Jay Powell's sitting there thinking, well, be careful for what you wish for, because we just found out how to generate inflation. You pump the economy with $10 trillion in fiscal stimulus, and then we're off to the races. So I do think that inflationary pressures will moderate. There is a mathematical reason for that as we see those base effects fade into the back half of next year. And then there is obviously advancement around technology that in our view will reassert itself and is wildly disinflationary. So as we see improvements in productivity, improvements in efficiency, those should bring down and dampen those inflationary pressures and get us back to a more normal environment in the back half of the year.
I accept you need a crystal ball to deal with some of this. Steve Englander over at Standard Chartered said the following: we think future market reaction will be heavily geared on incoming data that advances policy rate hikes. The data could include strong employment numbers that imply a quick approach to full employment or continued high inflation numbers. There's a good chance that we get both, and both will be the case in Q4 rather. Let's hope we don't have to wait around till 24. Maybe the benign reaction of the last 24 hours, Michael Purvis, that's what will be transitory. That's the view of Steve Englander. What's yours?
Well, I think just to build on Emily's point a little bit, if you look at the spread between five-year break-evens and five-year break-evens, that's at record levels. It's gotten even more extreme over the last several weeks here. And what that's sort of telling you is that a lot of the inflation narrative that Powell is talking is referencing, that everyone is seeing, when they walk into a Home Depot, that's pretty aggressively priced into the front end of the curve. And if you look at ultimately, if you want to think about why is that 10-year yield not going up the way it did in Q1, right? And why the yield curve is not expanding in tandem with the sell-off in treasuries over the last 3 months. It's really, I think it comes down to the term structure and break evens is mirroring the term structure in the nominal yield curve there. And it's basically saying that these structural disinflationary forces will square off against a lot of the pro-inflationary forces that we're seeing right now, many of which will extend into 22 and 23 and all that kind of stuff. So again, what I think we're looking at is that the total number of hikes in this cycle is kind of pretty well understood by the Treasury markets.
So let's get to the punchline. You're bullish on this market. You think the biggest risk is you're not bullish enough. Is that still true, Mike?
On equities? No, I'm very bullish on equities. I'm at 4,800 since July for year end, but I think that's too light, if anything, right there. And I'll probably be very constructive next year. But I'm also I'm not bearish of treasuries in concert with that. So I'm looking at a very stable back. And when I say treasuries, I'm talking about the 10-year, right? So I'm very much of the view that the 10-year is going to be range bound, but we're going to still see strong economic growth. There'll be little whispers or echoes of some stagflation, but I'm not a stagflationist at all.
Stable on bonds, very, very highly constructive on the equity market, 4,800, maybe we go north of that. Chris Harvey, you're 4,800, 4,825, I think, into year end, and then far less constructive through next year. Can you compare and contrast what you look for through year end, Chris, compared to what you expect through next year?
Sure, John. So what we think is we're going to have a bit of melt up, and we've already started that. And that's a combination of sentiment, and it's a combination of fundamentals. On the sentiment side, a lot of people don't believe you can break this market. You've bent it, but you can't break it. You're down 2%, 3%, 5%. Some of my peers were calling for down 10 or 20, but that never happened. And so now what you've done is you've gone from fear to greed. People think this thing's unbreakable, right? That's not great in the long term. In the short term, that can still drive things higher. On the fundamental side, we came into this earnings season believing that margins were going to get crushed and so on and so forth. Again, not our opinion, but what we're seeing is margins are stable. Results are better than expected. We still have incredibly low funding rates. Funding is widely available, and there's cash on the balance sheet. We're late in the cycle. There's not a ton of opportunities out there. So in order to make real return, you have to put more risk on the book and more leverage. That results in a melt-up. But when we look next year, what we see is decelerating growth. We see a Fed taking off accommodation, and we see some trouble with pricing and some other issues. So we do expect to see a pullback next year, but a melt-up into year-end.
Emily Rowland, your view on all of this? We've got Michael Purvis, highly constructive, thinks maybe he's not constructive enough. We've got Chris Harvey looking for the mount-up into year-end and something a whole lot softer through next year. Do you sit somewhere in between?
We think it's important not to get too comfortable in the fast lane heading into 2022. It was almost impossible to take enough risk at all this year in order to keep up with the markets. And of course, we think it's going to get harder heading into next year. We may have some modest infrastructure spending. That is not going to compete with the fiscal bazooka that we saw in 2020 and 2021. Central banks are making this big pivot. Yes, they're going to remain accommodative, but they're pulling away from this almost war-like monetary policy that we've seen over the last 18 months or so. We still think that there's opportunities. We still think that that earnings backdrop remains supportive, but we think it's going to be a lot more important to be selective under the hood. And that's one reason that we're focused on quality in particular, combining that with some higher quality cyclicals as we want to continue to play this recovery, this economic cycle that's unfolding, but we want to be very thoughtful about embracing companies that have strong fundamentals into next year.
Let's keep building on this into next year and through this program, through the next hour. Emily Rowland there, Michael Purvis, Chris Harvey. Coming up, the president doubling down on his economic agenda.
People are upset and uncertain about a lot of things, from COVID to school to jobs to a whole range of things, and the cost of a gallon of gasoline. And so if I'm able to pass, sign into law, my Build Back Better initiative, I'm in a position where you're going to see a lot of those things ameliorated quickly and swiftly.
Election losses fueling new urgency for Democrats in Washington. That's next. This is Bloomberg.
Engine number one was able to do on the Exxon fight, it opened a lot of people's eyes to, I guess, the power that smaller investors can have. And I'm curious as to how other people can sort of look at what you did and use that as either a template or maybe just some sort of guide as to how they can sort of approach their relationships with other companies.
We founded the company in Engine Number One on the idea that we take the data, not ratings and rankings of ESG of the past, but we actually take the environmental, the climate, the social, worker data, and we simply use it to look at the valuation of companies and look at it over a long period of time. And so if you think about it that way, you own these companies. Everybody that owns the company, whether you're a big institutional investor or you're a small retail investor, you own the company. You have a voice, you have a vote every year.
Yeah.
And so our approach is to use the vote and engage with these companies over time.
But that's always been the case, I mean, at least in theory.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
I think we should have passed before Election Day. People want us to get things done. They want us to get things done. And that's why I'm continuing to push very hard for the Democratic Party to move along and pass my infrastructure bill and my Build Back Better bill.
Democrats doubling down on the Biden agenda after a Republican sweep of statewide races in Virginia. Speaker Pelosi pushing the House towards a vote after announcing plans to add paid parental leave back into the spending package. For more, here's Emily Wilkins. Morning, Emily.
Morning. Well, we have a lot going on Capitol Hill in regards to that social welfare and tax plan. Leaders announced last night that there could be a vote in the House on both that bipartisan infrastructure and social welfare and tax reconciliation bill as early as today, but it could also be tomorrow. Leaders are trying to aim for this week, show that Democrats can get something done after those big losses in Virginia and elsewhere across the country. But John, let's be clear here. There is still a lot of work left to do. You saw paid family leave added back into the bill on the House side, but Senator Joe Manchin says that he's still not supportive of it. Other things being worked out is trying to get that state and local tax credit decided. There's still questions about what immigration will look like in the bill. And Senator Joe Manchin, as well as some other moderates in the House, are saying that they need more time, that they can't go ahead and rush this process. They need to thoroughly vet everything that's in the bill, and some of these new provisions that are coming out, they need time to review them, to look at them, and to understand what the budgetary impact needs to be. So there's a chance that this doesn't get done this week and that it only occurs later in the month.
Just on the timeline, Senator Manchin had this to say: we ought to be very careful of the timeline. Don't even set a timeline until we thoroughly vet this bill. There was a belief after the vote recently, Emily, that maybe Senator Manchin would have more leverage. Just having a look at what happened in the last 24 hours of pure observation, it felt like actually progressives were doubling down. Would that be your take? Is that fair?
Talking with the lawmakers that I have, I feel like everyone doubled down on their own position yesterday. Those who said they should wait say that we have to continue to wait, make sure this bill is a solid piece of legislation that's really going to help the American people. Those who are hoping to rush it are continuing to say, yes, we need to get this done and we need to get this done now. So I don't think the dynamics have shifted all that much, despite the fact that yesterday's loss for Democrats was acutely felt here up on Capitol Hill.
Emily Wilkins, thank you. Emily Ronan joining us alongside Michael Purvis, Chris Harvey. Chris, a quote of yours on a silver lining of the stalemate down in D.C. A GOP victory may be seen as a rebuke of the Biden administration's performance and economic plan, including its Build Back Better tax and spending bill. In our view, anything that potentially reduces the size or likelihood of new taxes is an incremental positive for equities. Chris, you're not the only one making this point. I just wonder how much of the move we've seen since the start of October, how much of this is behind it?
I think a lot of it's already priced in, but as you get incremental news, I think that helps the market at the margin. And I think that's the key word, at the margin. I think what happened yesterday is what I think people have an appetite for. They have an appetite for infrastructure, but they have a dwindling appetite for tax and spend. And the more that dwindles down, the better it is for the markets. But I think you're right. I think for the most part, we've priced a lot of that into the market, and you shouldn't expect much more upside from that.
Emily, would you share that view?
We do. And, we think broadly it's hard to get more fiscal spending here. It faces an uphill battle. We've already used a lot of political goodwill in terms of the stimulus that's been done over the past 18 months here. So the baton here really needs to get passed over to productivity, over to the consumer in order to continue to generate solid GDP growth heading into 2022. The good news is that consumers are flush with cash. Their balance sheets have grown, and we expect that strength of the consumer to really start to drive economic growth into 2022. But we need to look past fiscal stimulus as a key tailwind here for markets into next year.
Michael Purvis, one of the key features of your constructive view on this equity market is a stable bond market. This is what TD had to say on interest rates. Yields on the curve should remain caught between auction-size cuts, QE tapering, a likely fiscal package in coming weeks, and the market's repricing at the front end. This should keep volatility elevated, but with some upward pressure on rates. Mike McKee was on the program yesterday, Mike, and he talked about the twin taper, the reduction in auction sizes alongside the reduction in bond buying at the Fed. Do you think, Mike, that cancels each other out? Do you think that feeds into this idea that we get that stability that you're looking for?
Look, you know, since March 2020, when you saw a supply surge in treasuries, you know, bid to covers at the auctions were really very fine across the curve there. I think there's an added wrinkle. Look, I completely agree that there's a rise in rate volatility. That rise in rate volatility, though, is really much more on the front end than on the back end, right, there. And I think that, you know, as it relates to equities, you have to, you know, I think be much more focused on the back end being stable than whether the, you know,
just to jump in, why is that? Why would front end vol not spill over into risk assets, considering that's so heavily linked to what's happening with Fed funds?
Well, generally just, you know, equities, if you're looking at a discounted cash flow analysis, you're going to use a 10-year interest rate, not a 2-year interest rate. There's that facet of it. But I think what's also woven into that, into this discussion is the fact that the, you know, the total number of hikes that were priced through the end of 24 really hasn't moved since March of 31, right? When they were, you know, when there was a whole reflation theme going on in the rates market, right? So it was just more that they were foreshortened here. What I'd be much more focused on is an escalation of the back-end term premium really going to higher places, and that gets into a discussion about, you know, geez, do people want to buy treasuries because the debt to GDP is going in the wrong direction, or maybe overseas yields are getting substantially more positive, and the relative value argument doesn't wash anymore. So I think right now what you're looking at is that, you know, keep in mind, John, you know, even with the rises in the UK and Europe and so forth, and those yields, you still have $10 trillion of negative yielding debt. So to tie this back to equities, you know, I call it TINA squared, right? So you have you have to own equities because rates are 10-year treasuries are low and stable, and you have to low 10-year treasuries because bonds, et cetera, are extraordinarily low. So I think that setup is going to roll forwards into 22 and probably beyond as well.
I'm not being snarky about this. Emily, help me out here. When do you not want to own equities?
Well, if you saw that we were heading into a recessionary environment, you know, clearly that would be evidence that you would want to embrace high quality bonds. We look at the U.S. Conference Board's leading economic indicators, and they're still very elevated on a year-over-year basis at around 9%. But if we continue to decelerate at the rate we are, that would mean that a recession was forthcoming potentially at the end of 2022. So the challenge here is that this cycle is aging incredibly quickly. So that means you've got to be a lot more flexible, a lot more nimble in terms of asset allocation. We still want to embrace bonds at this point in the cycle, but we do think that equities need to do a little bit more of the heavy lifting here as we enter this mid-cycle environment that tends to be a pretty good one for equities. You've got to be thoughtful about fixed income. We like BBB bonds. We like a little bit of BB in there for that extra yield potential. And, you know, certainly high quality bonds just are not going to cut it in this environment.
Chris Harvey, that deceleration Emily just talked about into next year, is that a feature of why you think we can have a struggle?
I think so, right? Let's think about this. What do you have next year? You have Fed fund tapering. It's probably done by the middle half or by early spring, we'll say, okay? People, it doesn't matter if the Fed's going to raise rates or not. What matters is their perception. And the perception is they're going to raise rates. That's a problem. The other problem is, yes, we will see EPS growth, but it's going to decelerate. More importantly, we're likely going to have multiple compression. It will be the second year of recovery, and that's when you have multiple compression. And the last thing is, I think what investors are going to do is they're going to bring equities up to a level that you can't sustain them over the next 3, maybe 6 months. And you ask, why do you have a sell-off? You have a sell-off when prices go down. Why do prices go down? People get too aggressive. And I don't think after our market melt-up, you're going to be able to sustain those prices. So yes, we believe that maybe it's second quarter, maybe it's second half of next year, you want to be very wary of equities. And the last thing I would say is your risk aversion assets are very limited at this point in time. The market's telling you everyone's moved away from risk aversion, not a catalyst, but longer term, what that tells you is it's time to start getting ready to get ready.
I like that, Chris. Sell-off happens when prices go down. Chris Harvey, Emily Rowland, Michael Purvis. Thank you, sir. Equity futures positive, up 7 points on the S&P. Up next, the morning calls, and later, earnings season winding down with your equity market at all-time highs. From New York, this is Bloomberg.
The past 18 months have reminded us how essential the PC is to work, life, learning, and connecting. And with Windows 11, we have renewed sense of the role Windows plays in the world. It offers personal agency and real choice to users.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
About 5 minutes away from the opening bell, equity futures up 1/10 of 1%. 5-day winning streak on the S&P into Thursday, all-time highs. That's the price section. Here are the morning calls. First up, Citi downgrading Zillow to neutral and cutting its price target by more than 50%. The analyst expecting steep declines after announcing its exit from its iBuying business. Next up, Argus downgrading Starbucks to a hold. The analyst citing a number of headwinds, including supply chain challenges and rising labor costs. And finally, Goldman upgrading Qualcomm to a buy after quarterly results, forecasting better margins and earnings growth due to momentum in high-end Androids. We're up there, by about 12%. Coming up, mounting concerns on your equity market as this equity market rally continues. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
What a winning streak in this market. On the S&P 500, 5 days. On the NASDAQ, make it 8. Coming into Thursday, can we add some weight to that rally? Up a little more than 1/10% on S&P 500 futures, advancing 6. On the NASDAQ, at 49, advancing about 1/3%. That's the opening bell. Switch up the board and get to the bond market. Yields coming in 3 or 4 basis points on 10s to 156.47. In the FX market, the dollar is a whole lot stronger against the euro and against sterling too this morning. Euro dollar 115.63. We're negative 0.4% on that currency pair. Outside of that, crude bouncing back again, up 2.71%, advancing to an 83 handle on WTI, just north of that, $83 and about 10 cents. So that's your opening bell. A flat market in the equity market. Energy bouncing back by 1.1%. Top of the pile, your overall index up by 0.16%. Bottom of the pile, healthcare down 1/3%, financials off by about 1/4%, and that bond market rally not helping the cause there either. On real rates, let's talk about it. Luke Cower over at UBS sounding the alarm on real rates and saying the following: real yields may adjust upwards to acknowledge the strong runway for both growth and inflation this cycle. This would likely be positive for our preferred pro-cyclical relative value equity positions. However, a disorderly rise in real yields could challenge equity valuations. For more on this is Katie Lyons. Hey, Kaylee.
Hey, John. Well, for now, real yields are still deeply negative. You take that nominal yield, you strip out inflation, and you end up with a real rate that is sub-1%, negative 103 basis points actually this morning. And that has been largely supportive for risk assets, helped us get to the record highs at which we now sit. But if we were to see a spike upward in real yields, that could be a different story. As Luke says, most vulnerable could be those richly valued areas of the market. And of course, while real yields are persistently low, we have seen break-evens moving higher, nominal yields moving higher as well. And bonds have been seeing pretty large swings in general. The MOVE index, which is a measure of the volatility in the bond market, has been climbing higher. It's north of 70, heading in a totally different direction than the VIX, which of course gauges equity market volatility. There, we're sub 15. And strategists like those at Bank of America say that can't last forever, and that eventually the equity market is going to have to catch up to the signals the bond market is saying about a more not so advantageous policy environment. The thing is, what's feeding the bull thesis is earnings. We've had more than 80% of companies surprising to the upside this earnings season. On average, growth is expected to be more than 30% when it's all said and done, but we are in a decelerating earnings growth environment. It's expected to slow even further in 2022 at the same time that policy on the monetary front is normalizing. And Mike Wilson over at Morgan Stanley says you add that all together and the fundamental picture for equities is deteriorating, John.
Katie Lyons, thank you very much. Working through the real rate story. Just on the Bank of England quickly, for anyone who's been following that news conference over on Threadneedle Street in London in the UK, Bank of England Governor Andrew Bailey taking a bit of stick for not hiking interest rates after a strong guide towards a meeting which they said was a live meeting. Some people left disappointed because they did not hike interest rates. 9-member MPC, the vote split 7-2, 2 voting for a hike, 7 saying no. Governor Bailey now cautious on the scale of rate bets seen in markets. That headline dropping about 40 minutes ago. Sterling weaker off the back of all of this, as you might expect. Cable down to 135.46. Negative there about 1%. I'll work through the Bloomberg terminal with you and bring up the gilt curve in the UK. I want to go to the front end of the curve in response to all of this. 2-year gilt yields are down 17 basis points off the back of this meeting. A break of 50 now at 0.496%. No doubt Guy Johnson's going to pick up on this story at the top of the hour. Just wanted to get you up to speed. Taking some real stick at the Bank of England. Will they hike in December? Is the unreliable boyfriend back over at the Bank of England? For people who don't remember that, Google Governor Carney, unreliable boyfriend. It will refresh your memory a little bit. Lafayette's College and Krishna Mamani warning that equities won't be able to survive rising real yields. Let's get back to that story. Take a listen.
If that happens, the likelihood that the equity market continues to be where it is basically zero. If real rates get as positive, then there'll be hell to pay on the equity market because what we are building in is expectations that real rates are going to remain low for the foreseeable future. One part of it is inflation today, but the other part is rates remaining low for the foreseeable future, even through this non-transitory, transitory period.
A non-transitory, transitory period. Krishna seriously winding me up. Emily Rowland, Michael Purvis, Chris Harvey. Chris, this is a perfect way of starting the conversation with you. You've said recently, our trading call at tech, on tech, may be at risk, especially across high-octane names. The Fed's anticipated taper announcement this week, they announced it, may potentially catalyze a significant directional change in real rates. We believe the eventual real break-even reversion will be sharp. Chris, on tech, on real rates, walk us through it.
Yeah, so what we've seen this year, real rates go down, tech, high growth outperforms. Real rates go up, you see the opposite. You see financials, you see cyclicals work. What we're seeing in the marketplace right now is kind of, yeah, you referenced it before. We're really seeing nominals somewhat capped. And so what you're doing is you're expressing your views in break-evens and reals. And as break-evens go higher, reals have to go down more or less. Okay, yeah, nominals will go up a little bit, but really it's being expressed across these two series. And so what we think is happening, right, longer term, the market is worried about stagflation, right? So break-evens go up, reals go down. What we say is stagflation. We think that inflation is going to eat into growth, and that's going to be bad, and so on and so forth, and the Fed's maybe making a policy error. What we've been saying, and we'll see how this works out, is the Fed is the 8,000-pound gorilla. Right? When they start stepping out, you should start seeing real rates start to drift higher. They go from the 8,000-pound gorilla to the 800-pound gorilla. If they're not buying or they're not hoovering up all the bonds they possibly can, it should go higher, albeit at a rather slow pace. And that should be good for your cyclical trade. Now, the last thing I would add is the stock market is much more oriented to growth. So if you do see real rates go higher, it is a little bit of an impediment to higher equity prices or very large upward equity prices. But I still think equity prices can go higher in a whole, just probably not as much.
That's the point Krishna Mamani was trying to make and the pushback that came from Krishna. Emily, the idea being that if you expect broad equity positive returns from the benchmark, from the index, expecting to have that outperformance from value and those two things happening together continuously like it has done through this year, expecting that to persist is unlikely. It's an unreliable story to lean on. Emily, where'd you come down on that?
Yeah, so we've been overweight both growth and value in the U.S. this year, and they've really performed neck and neck. You know, going into next year, we think it's important to emphasize growth. And I want to push a little bit on Chris's argument around rates, because what we've seen in previous examples of Fed tapering is that the yield on 10-year treasuries actually rose when tapering was hinted at. Even when tapering began. But then in both of the last two examples in 2011 and 2013, we actually saw yields fall as investors got concerned that the Fed was pulling away the punch bowl, and they actually embraced the safety of the 10-year treasury. So if your argument is that growth stocks, aren't going to do well as rates back up, we really don't see that. We actually see this decelerating growth environment. Matt Miskin and I have been coming on your show, for the last 6 months saying that we thought that the high in the 10-year treasury was already in for this cycle at 175 back at the end of March. We think it chops around from here and ultimately, does move lower as this economic backdrop, while still positive, continues to decelerate into next year.
You, Matt Miskin, Francis Donald as well, all lining up saying the same thing. I hear you, Emily. Chris Harvey, you were name checked there. Your response?
No, I think Emily says, I agree with a lot of the things that she says. If you look into 2022, you do want to have a higher growth approach. Our point is, so as real rates go up or go down, you're going to have a reaction function in the equity market. Are rates capped, and are they capped? That's a longer discussion. But do we think that you have 3 to 6 months for this cyclical trade? Yes. After that, we get a lot more nervous, and we think that higher quality does make sense. But in the short term, you can see the cyclical trade work. You can see many things work. Again, we think equities do go higher, but you have to be worried about the second half of 2022 and probably starting in the second quarter of 2022.
Michael Purvis itching to get in. Go on, Mike.
No, just a different facet of this discussion is what happens with the dollar. If Luke is right and real rates do jump up here, how abruptly does that happen and to what level does that happen? So what we've seen since, for several years, but really since March of 2020 is Powell has been very focused on the dollar, making sure, to try to keep it as non-strong as possible there. And we've seen some dollar strength this year, right? Commodities have been rallying broadly, and the dollar has been rallying too. And a lot of that has to do with real rate differentials between, say, Europe and the United States there. So if reals over here jump 50 basis points here, that's going to be an issue for the Fed, and it's going to, sort of, I think, bring back a much more dovish narrative, than even more dovish than what we've been seeing. So I think that's
to wrap things up. Forgive me for jumping in.
Yep.
You're very constructive on this equity market. Emily Rowland is a lot more cautious, wants to be nimble. Chris Harvey, very, very cautious going into next year compared to the mount-up theory he's got into year-end. When Emily Rowland talks about the deceleration we're expecting next year, when Emily Rowland talks about what she calls the end of earnings nirvana through next year, do you disagree with those points, or are you just thinking the market responds to them differently? Which one is it?
Look, I think the nominal GDP setup, which ultimately is going to drive S&P top line and bottom line, is still very strong next year. There's no question that peak acceleration is in. I mean, it's Q2 is locked, right? I mean, I think we know that, right? But the nominal GDP story for next year and into 23, I think, is still going to be pretty good. A lot of the supply chain issues throughout the value sector are going to spill over. Are going to reinforce, a better growth profile next year. If you didn't buy your Ford 150 this year because you couldn't, you'll buy it next year and so forth, right? So I think there's that story. And by the way, if you go back to every time that you've had a surge in earnings growth, like we did in this past summer, on a 12-month forward period, the last 4 times it's only been bad was back in 2000, right? In the last 3 times you've had a surge in earnings growth. Deacceleration doesn't mean bad market performance. Obviously, you need growth, but it has to be growth that the market's comfortable. And again, you get back to bond yields, and it's going to really reinforce a buy the dip into 22.
Let's finish here then, Emily. I'll give you the final word on all of this. Why is it the rate of change you think is more important here and not the absolute? If we had a 4 or 5 handle on GDP next year, why is it the rate of change that's so important to you and not the absolute?
I love it when you give me the final word. So it's really important here to keep in mind that this cycle is moving quickly. And we all need to remember that the cycle never dies of old age. It's killed by the Fed. So the Fed is in between a rock and a hard place right now. The 2-10 spread is sitting at about 100 basis points right now. Typically, it's about 300 basis points the last couple of times that the Fed raises rates. So they're in a really tough position. If they decide that they've got to respond to these inflationary pressures that seem to be more persistent, that is going to quicken the cycle even faster. This is not a great time to load up on cyclicality in a portfolio. It's a really important time to be more thoughtful and embrace those higher quality areas of the market.
Emily, thank you. You can have the final word whenever you like. Chris and Michael don't mind. Emily Rowland, Chris Harvey, Michael Purvis. Guys, thank you very much. Appreciate it. Coming up on the program, it's the US versus OPEC. Front and center, crude up by about 70% year to date. And this administration wants OPEC to do something about it. That conversation's next. This is Bloomberg.
We are on the verge of a disaster.
Join us live from Glasgow for coverage of the COP26 Climate Change Conference.
People are beginning to build some momentum, I think. The question is, will it be enough?
We'll speak with global leaders, keep you up to date on progress and setbacks, and analyze what it all means to you.
We're going to need to see some real action.
COP26, the UN Climate Change Conference, this week on Bloomberg Television and Radio.
Проходим опасный участок, ответственный. Ну там, поднимайте, нажимали. Шерпа страхует.
Очень много думал о том, что я сделал, и понял, что сделал какую-то нереальную вещь. Не знаю. Я до конца как бы внутри себя даже не могу поверить, что я через это прошел. Состояние, наверное, организм истощен, потому что очень много физической работы. Своим вот этим поступком хотел сказать, что только через действие в этой жизни достичь можно абсолютно всего.
I say that we can basically do more for ourselves. We've been energy independent for the first time in 67 years. Why can't we do more? Why can't we produce more? We've got plenty of natural gas. My state, beautiful state of West Virginia, has an ocean of natural gas under it. If they just let us build a pipeline, we could get the product to market. And why don't we do more drilling? And why don't we do more, basically, production in the United States? I'm not depending on OPEC. I'm not depending on other countries for my energy anymore. We know how to do it. We have the technology. We should be relying on ourselves.
A really interesting interview with Senator Manchin there and Brett Baer over on Fox News yesterday evening. The President of the United States is blaming OPEC Plus for the rally we've had in crude this year, a move of, say, 70%. He thinks that the Saudis and Russia should do more. Senator Manchin saying we can do stuff at home. Other people agree with him. We can invest here in America. We can do something with the pipeline, but they were the decisions that this administration made to disincentivize investment at home. But for some reason, once crude start rallying, it's someone else's problem. It's OPEC Plus, it's Russia, it's Saudi. Crude right now, 82, 89 on WTI, 84 on Brent. With us is Will Kennedy over in London. Will OPEC Plus fold?
Bit too early to say, but the preliminary indications are that perhaps they won't. We know that they have been presented with some requests by the US to perhaps go twice as fast this month, go to 800 rather than 400. But from what we hear, there isn't that much discussion of that happening. They're still meeting. It could change. We should hear what is going on in those deliberations shortly. But it does look as maybe that the President and OPEC are headed on a collision course here.
Well, interesting to look at the collision course at home here in the United States of America. If you could compare and contrast the comments there from Senator Manchin with some sound of the President earlier this week, the difference would be stark. Senator Manchin saying we can do more at home in America. The President saying this is about OPEC Plus, it's about Russia, it's about Saudi. For someone like you who can strip all of the politics out of this, Will, when you look at this from purely a commodity, a market perspective, what's your take on what's happened with energy this year?
I mean, the big story here, and this points to some of the things that Senator Manchin was talking about, is that shale is the dog that hasn't barked in the oil market this year. We've seen prices rally 7%, as you said at the start of the segment, John. But so far, shale, which over the last 10 years has really been the barrels that have come onto the market to keep prices suppressed, they're holding their line. I mean, there's a bit of extra production from the Permian, but it's not a huge amount. And that's really what's dominating the market here and allowing OPEC to dictate terms.
What do you make of the pipeline issues in the United States, Will? Do you think that's made a difference?
I don't think that it's necessarily made a difference in the short term. I think longer term it could come into focus. Clearly, there's been a decision that new pipelines are incompatible with the climate goals that the Biden administration wants to reach, and it will eventually keep some fossil fuels from market. It's going to be controversial. There are going to be people who are more pro-fossil fuels who think those pipelines need to be built. Are going to argue that that's part of the price picture, but I don't think in the short term it's fed into the rally this year.
Well, the SPR's back in the news here in America. Halima Croft, who I'm sure you know well, over at RBC Capital Markets, has said, we think the Biden administration is prepared to release crude from the Strategic Petroleum Reserve in an effort to cap prices. Can I just get a final word from you on that, Will Kennedy, on the SPR? Just to repeat that quote again, we think the Biden administration is prepared to release crude from the Strategic Petroleum Reserve in an effort to cap prices. What say you, Will?
Biden, if he gets rebuffed by Saudi Arabia and the rest of OPEC Plus, is going to have to respond. And I think the consensus is that this is one way that he can respond and look like he's not taking no for an answer and actually perhaps dampen prices. The problem he has is if you do it once, is there an expectation you have to do it again and again?
And at 80, well, has that surprised you? Just a final word on that. Has it surprised you that we're doing this at levels that aren't historically incredibly high, given recent history?
Yeah, but I think that's right. I mean, we've seen prices well over 100, and we saw them over 100 for a sustained period in the 5 years after the financial crisis. However, I think what you need to be looking at is gasoline prices in the US, which are at a very elevated level, 7 years high, and clearly a big political problem for the administration.
Well, good to see you. As always, Will Kennedy there, out of London on this commodity market. Brent crude, 83.92, up more than 2%, bouncing back from yesterday. WTI, 82.73, up 2.34%. We've got a record high in this equity market. Breaking it down, our stocks editor, Dave Wilson. Hey, Dave.
Hey, John. You've only got 5 of the 11 main industry groups in the S&P 500 higher, but there are some key groups leading the way. Energy, you were just talking about what's going on with oil prices. That's certainly helping. You look at the consumer discretionary category, and you have to remember it's a pretty broad lineup of stocks. So, we're seeing some well-received reports from a number of companies that are sort of helping that group move higher. Even the arts and crafts marketplace, Etsy, is contributing to the gain. Technology stocks doing relatively well on the other side. Financials, the worst performers on the day among the 11 main groups. Within technology, it's worth focusing more on the chip makers. We had results out of a couple of them late yesterday, and you've seen the shares move in opposite directions. Qualcomm up almost 14%, while Qorvo is down almost 14%. Thing is, though, Qualcomm, a much bigger company, so what you're seeing on balance with the Philadelphia Semiconductor Index is another gain, which would be another record. And if it holds up, it would be the 6th straight advance for this gauge, and it would match the longest streak of gains this year.
Dave, when are we done with earnings season? How many more weeks? Are we done?
Well, we're close. I mean, you kind of get to the point, John, where it's media companies. We've seen some of those with Viacom, CBS, and Fox. And then, the retailers come straggling in because for most of them, the fiscal calendar is a month behind the actual calendar. So we'll get those results over the next couple of weeks.
Great to have you with us, Dave, as always. Dave Wilson, to lean on his expertise, his history of this company as well. Dave Wilson, thank you, sir, our stocks editor. Your equity market for 6 straight days now is higher on the S&P 500, a 6-day winning streak, all-time highs in the equity market, longest winning streak since October 21, when it was 7. The longest winning streak of the year so far, though, on the NASDAQ 100, it's 9 days now, the longest winning streak since December 8th of last year, 2020. Your equity market, record highs across the board. Up next, the market moving events you need to be watching. I'll bring you the trading diary, the guide into the weekend. Payrolls around the corner. From New York, this is Bloomberg.
inflection point. Just finishing what you were saying, Tom. November 3rd is when the decision is. Just in case people got confused, I will. Just one more story, Tom.
Yeah, thank God for that.
We're at 137 right now into weakness. Is this where they play the music in the Academy Awards? Is this it? Do I thank my mum again? Are you in charge of this?
Is she the only one?
Kill the music. You know who's in charge here.
Do you see Deutsche Bank ready to pay more and pay out more in terms of bonuses for staff to have that strong talent that I'm sure you want?
Well, look, it's a war for talent. It has been, in other cycles before. It is now. We're finding that we're competitive in that war for talent.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
25 minutes into the session, here's the equity market. Another day of gains on the S&P 500. Could be 6, up a third of 1% on the NASDAQ. Another all-time high, up a half of 1%. That's the equity story. Switch up the board and get to the bond market story. Not just treasuries today, but gilts as well. The front end of the yield curve in focus. We're down 4 basis points on 2s in the US at 42 basis points. Talked a lot about Chairman Powell. Talk a little bit more about Governor Bailey in the UK. When you have a monster move at the front end of the curve, like we've got today over in the UK, something's gone wrong. Now, I don't want to validate this idea that the bond market needs its handheld all the time, but if communication's that off with the market and you get a move that big, something's gone wrong with communication at some point. That's the bond market. Let's get you the trading diary. The events you need to be watching through the week, into the end of the week, it's about payrolls. The report coming tomorrow. Powell, Harker, Evans kicking off a big week of Fed Speak on Monday. CPI numbers out on Wednesday. Plus, we'll get Disney earnings. The US bond market closing for Veterans Day on Thursday. And finally, the University of Michigan Consumer Sentiment Survey coming out next Friday. Not tomorrow, but next Friday. The focus tomorrow is very much on payrolls Friday. Looking ahead to tomorrow, 450K is your estimate. The range is wide as ever. 700K at the low end, at the high end rather. At the low end is 250. I'll bring you the payrolls report tomorrow on Bloomberg TV from New York City. Thanks for choosing Bloomberg. This was the countdown to the open. This is Bloomberg.
The energy crisis, there's a lack of drivers. Is there anything that you need to ask authorities to do better, or that your clients want the UK to do better?
I think we're at a moment in time where we're coming out of the pandemic and there are a handful of things going on. I think all over the world there are labor issues that are really a reflection of this transition out of the pandemic. There are supply chain issues. Some of this stuff is transitory. There are some secular trends that we have to watch closely. But I think we're adjusting and dealing with it as anybody else is. And I think leaders here are thinking about it the same way leaders are around the world.
When you look at the UK and, of course, some of these green investments that the UK and the City of London particularly has been really trying to pitch, you've been extremely involved in carbon offsetting. Can London really spearhead that movement?
Well, I think it's important that governments around the world partner with the private sector to try to get capital directed toward innovation in a way that we can accelerate the climate transition. And I want to emphasize it's clearly a transition.
From New York City.
We're here in London, in Sydney,
in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology. And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims front.
How are you thinking about those dynamics?
Months after Hurricane Maria, Puerto Rico is still in peril. Huge swaths of the island are still without power, running water, or access to medical care. Experts estimate that it will take years before these services are restored island-wide. Much of the blame has been placed on FEMA for a slow response in comparison to recent disasters on the mainland. But recovery from a disaster of this complexity and scale has proven more challenging than anyone anticipated. And filling the gaps between an overextended public sector and a suffering populace falls on the private citizens. Robert Anderson is a Puerto Rico resident of 4 years.
The eye of the storm came in south of El Yunque, swept up towards San Juan, and out to Arecibo. Everything on the right-hand side is what we call the dirty side of the storm.
This isn't his first time in a disaster zone. With a military and telecom background, Anderson worked on repairing damaged cell phone towers in New Orleans after Hurricane Katrina. Some might be tempted to label him a disaster capitalist, seeking lucrative government contracts for his expertise. But as Anderson finds himself in the middle of a humanitarian crisis, he and his associates are developing a variety of pro bono recovery projects that target the island's hardest hit areas.
I see two Puerto Ricos. We're here in San Juan. They have telecommunications restored. They may or may not have power, but basic services are in place. They're able to get food. They're able to buy things. They're surviving. And when you look outside of the San Juan area, you can go 15 minutes from here and find areas that are devastated. I'm working on the devastated side.
Today, he's put together a boots-on-the-ground mission to provide medical care to some of the island's most isolated and vulnerable residents. Steve Berenbaum is one of Anderson's business associates. He offered an extra car and a set of hands.
So we received an initial report from a nurse that was out in the area. We're headed to the northeast region of Utuado for some people that are in need of urgent medical assistance.
Dr. Sally Priester is a physician from San Juan. She filled a van with medical supplies at her own expense and brought along a team of nurses. Google Maps estimated our first destination to be a 90-minute drive. But it didn't account for obstacles like this. Our first stop was the home of an 82-year-old blind Vietnam veteran. His roof was blown off by the storm, and he's been living alone in a back shed for nearly 2 months.
His cane actually got broken in the storm, so he's limited mobility. He has a number of medical ailments. Dr. Priester's having a look at him. We called the VA. They're going to get him set up with what he needs, get him stabilized so he can then be transported either to an evacuation center or off the island. It's when the chain gets broken, when those families that are connected to them leave the island or take off. These guys get left at the end of the road, and it's tough.
FEMA was not officially part of Robert's team, and their arrival caught everyone by surprise. Their job here was to survey and report back to their superiors, and did not come with medical aid of any kind.
People think that FEMA is there to hand out bottles of water. It's not what they do. FEMA has a role to play. They have a very specific role. They bring in ships, they bring in airplanes, they bring in tractor trailers with pallets of things. But they're a big machine, and there's gaps in that thing. And you're seeing one of the gaps here, and we help fill that role. These guys are in a bad situation before, and now they're struggling for real basic things. One of the risks that you run is people going from fear to hopelessness. Those are the folks that we're trying to reach.
And how are they reached? How are they even found?
Word of mouth, mostly.
And what's your role in all this?
Ghost in the machine. I'm lucky enough to be able to communicate with folks in FEMA, the state of Puerto Rico.
For a ghost, Robert makes his presence well known. Not only was he the de facto leader of the mission, now with FEMA in tow, he created his own maps to survey storm damage.
So we're right here.
And delivered them to FEMA HQ free of charge.
I have pretty good reach.
Perhaps that's how he managed to earn himself a coveted FEMA badge without actually working for them. And it's these relationships that allow him to operate more efficiently than an NGO or a government agency.
We're able to resolve problems at a different level.
Our next stop was on a mountaintop, a family of 11 struggling to care for their special needs brother in what was left of their house.
Probably we are the first health team to come and visit this family.
Muy bien, todo muy bien.
The patient has Down syndrome. He is all day in bed. The difficulty with this is the patient cannot be alone. The most important thing is that you need to take care of the chronic disease besides disability, because they have been not going to a doctor, and no doctor has come in here yet.
So we need a refill of this medication.
After maybe 54 days, it's not getting better. And the only way that you can be able to see that is coming to the ground, drive, and see the people and talk to the people.
You can see San Juan from here, but you can't get there. It's like the Emerald City.
On this stop, we caught word that a man living alone at the edge of the jungle was in need of care.
So we decided to take a little detour, come up here and check out and see what's going on. One of the challenges is to find those people that are at the end of these roads that need help.
¿Pero por qué estás solo? ¿Por qué estás por acá? I'm asking about why he's alone right here. He said things of life happens. Yeah, I'm here by myself. So ¿dónde vive acá? En la parte de... This is not a job. To do this, you need to have passion for what you can do. You're not going to get paid.
It's said in disaster response and emergency response that the real first responders are your neighbors. You don't need to wait for a lucrative FEMA contract to go out and do good and to help the community.
In the end, do you feel like you're making a difference?
Lives you touch and people that you can affect. I don't really think about it in those terms.
But why do you do it?
It helps me sleep at night. I think it's as much for the people that are going out to help and do things as it is for the people that you affect.
Whether out of altruism, or the lure of a paid gig, or some mixture of the two, Anderson hopes to stay here to help shape Puerto Rico's future.
Puerto Rico's essentially been a colony for 400 years. It was treated poorly by the Spanish. It was not treated well by the United States when they first got here. Puerto Rico can continue in the way that it's always been, or Puerto Rico can rebuild itself like nothing that's ever been. And we have to do everything we can to make that real. That's the bottom line.
When I met him first online, I found him to be really sweet. I think I was the one who was talking for an hour. He was just listening.
When we met, I saw her. She was beautiful, intelligent, and kind, which was, something that I was looking for.
Anshu and Sumit are one of about 12 million couples that get married in India every year. Unlike their parents' generation, they're not from two close villages, but from two cities on opposite sides of the country. And their love didn't start through community matchmaking, marriage brokers, or classified ads in newspapers, but began online.
So we met through jeevansathi.com. So it's basically an online portal where we have detailed profile of different grooms and brides.
It makes a lot of remote profiles who are located in distant areas more accessible.
Thanks to growing internet and smartphone usage, matrimony websites and apps in India are starting to disrupt the matchmaking industry. More and more people are finding their partners at the click of a mouse. jeevansathi.com, where Anshu and Sumit met, is one of the biggest players. Young Indians looking for love set up profiles including their caste and horoscope, but their criteria for choosing spouses appears to be changing.
We have seen the shift from, traditional caste community conservative parameters to something like which is more focused on education, employment.
Anshu and Sumit's marriage was initiated by their parents, but modern Indian couples like them have more input than previous generations.
We looked up to them to agree for the proposal, but it was primarily our decision that we wanted to be with each other.
So what's the emoji like you use the most to send to each other?
There's a bear which basically we use for indicating a hug.
Yeah, that's our language basically. Bear icon for a hug.
Time flies when you're in love, and just 1.5 months after they first met online, the couple got engaged. They decided to hold their wedding less than 3 months later. But planning a traditional Hindu wedding on such short notice is no easy task. The massive event usually lasts 3 days, has various ceremonies and celebrations, and involves the entire two families and hundreds of guests. Luckily, there are websites and apps for that.
We searched online, we got in touch with Wedding Brigade, and they helped us finalize the venue. And it makes the search faster and efficient.
Startups like the Wedding Brigade are challenging traditional wedding planners in this $50 billion industry. It provides various services from booking banquet venues to buying wedding gowns. The website makes money by charging commission from vendors.
People don't want to be limited to what is available around them. They want to know the entire range of options available before making a decision. And now it's easy to find almost everything on one portal.
Anshu and Sumit are officially married in a ritual that has gone on for thousands of years, but their love started in a very new way. Technologies might be changing the way couples meet, date, and get married in India, but they're definitely not changing everything.
The technology was only the first level help that we could get to find each other. Everything else was like very humanly and emotions and feelings based.
Massachusetts Senator Elizabeth Warren has become a symbol of everything the Republican Party stands against.
Everyone gets a right to basic health care. We need strong oversight of these banks.
A legal scholar and a consumer advocate turned politician, Warren has branded herself as a champion of the working class and made a career out of standing up to big business. While rumors of a 2020 presidency bid remain just that,
I'm not running for president.
Her Senate seat is up for re-election in 2018, and Republicans are already pumping millions into super PACs to defeat her. This is the story of how a law professor and politician came to be seen as the biggest threat to Republican values and the greatest hope for progressive America. Elizabeth Warren was born Elizabeth Ann Herron, the youngest of 3 siblings, on June 22, 1949 in Oklahoma City to middle-class parents. After waiting tables to help her family pay the bills, Warren became a star on the high school debate team. She landed a scholarship to George Washington University at the age of 16, but 2 years later dropped out to marry her high school sweetheart, Jim Warren. By 1980, Warren was a mother of 2, divorced and remarried, had earned a bachelor's degree from the University of Houston, a juris degree from Rutgers, and practicing law in New Jersey. Warren then went on to become an influential law professor, teaching, lecturing, and publishing highly cited work on bankruptcy and commercial law at 7 universities around the country, eventually settling at Harvard Law School. But Warren wasn't always a liberal lion.
Elizabeth Warren used to be a Republican, actually.
That's Stephen Dennis.
I'm a Senate reporter for Bloomberg. Around the time that Elizabeth Warren switched parties, she became a fierce opponent of a Republican drive to make it much harder to file for bankruptcy. She fought that for a decade. It ended up passing anyways.
While her efforts ultimately failed, her warning calls were heard in 2008.
We're in the midst of a serious financial crisis. Our entire economy is in danger, and without immediate action by Congress, America could slip into a financial panic, and a distressing scenario would unfold.
Professor Warren was tapped to help with oversight in the government bailout.
She would excoriate bankers and their bonuses and their practices.
Why should the U.S. taxpayer alone carry city?
She proposed a series of tough regulations, which became the basis for much of the Dodd-Frank financial law that we have today. That sort of catapulted her to national stardom, particularly among the progressive left.
Encouraged by her newfound notoriety, Warren declared her bid for the U.S. Senate on September 14, 2011. During the race, her opponent Scott Brown tried to derail Warren by accusing her of falsely claiming Native American heritage, a controversy that earned her the nickname Pocahontas. Nevertheless, she was victorious and won the Senate seat by a comfortable margin. She used her new tenure to challenge everyone, from banking regulators and Treasury officials to members of Wall Street and Congress.
I'm really concerned that too big to fail has become too big for trial. We need tough new laws to hold corporate executives personally accountable. No one should be above the law.
She called for Wells Fargo CEO John Stump to resign for fraud, introduced the Bank on Student Loans Fairness Act, and reintroduced the 21st Century Glass-Steagall Act. In 2016, after staying silent during the Democratic primary battle, Warren finally endorsed Hillary Clinton and had some harsh words for candidate Trump.
Donald Trump is a loud, nasty, thin-skinned fraud who has never risked anything for anyone, and that is just one of the many reasons he will never be president of the United States.
But she was wrong.
The forgotten men and women of our country will be forgotten no longer.
Warren wasted no time resisting Trump's agenda.
Have you ever managed or overseen a $1 trillion loan program?
I have not.
How about a $1 billion loan program?
I have not.
In the Donald Trump era, Elizabeth Warren has been playing defense and trying to prevent Donald Trump and his cabinet appointees from rolling back protections that she helped enact.
Warren actually found herself rebuked by Mitch McConnell for reading a letter by Coretta Scott King about Jeff Sessions' record on racism during his confirmation.
She was warned. She was given an explanation. Nevertheless, she persisted.
That moment became something that's on T-shirts, bumper stickers, slogans, and that really galvanized a lot of support for her. It's been very hard for Republicans to get much of anything done this year, and that's at least in part to this resistance movement that Elizabeth Warren has helped champion.
We are here to fight back.
Enough of Elizabeth Warren. Like you.
Millions of dollars are being funneled to defeat Warren in the midterm elections in 2018. But it's the rumors of a 2020 presidential bid that has further prompted powerful donors to fund her opposition, often using the same playbook of constant and ruthless ad campaigns that many believe helped Trump win in 2016. It's anyone's guess if she will endure what Hillary could not.
You know, the question for Elizabeth Warren is whether she can go from being a liberal firebrand to somebody who can regularly get 60 votes for initiatives in the Senate and 218 in the House and drive an agenda, and whether she can bring together coalitions for political victories. That's the challenge, and we'll see what happens.
Sadiq Khan, the mayor of London, has made some powerful opponents.
He doesn't know me, never met me, doesn't know what I'm all about. I think they're very rude statements, and frankly, tell him I will remember those statements.
My message to Donald Trump and his team is that, your views of Islam are ignorant.
He's the first Muslim mayor of a major Western capital and proud of it. This is how Sadiq Khan went from the son of Pakistani immigrants to a lawyer, lawmaker, and now the mayor of London. Khan's parents emigrated from Pakistan. His father was a bus driver, his mother a stay-at-home seamstress. The 10-strong Khan family squeezed into a 3-bedroom flat in South London. He wanted to be a dentist, but TV in the 1980s convinced him otherwise.
Objection!
LA law with its swagger and ill-fitting suits caught Khan's eye. He graduated in 1991 with a degree in law from North London University and joined a human rights firm. Khan worked a number of high-profile cases, often clashing with London's Metropolitan Police Force. But he had bigger political ambitions.
This is what being a new MP is like, squatting on a bench in the absence of an office, dealing with letters from constituents.
Reports are just coming in of an explosion here in London.
So there's just explosions, and then it was just smoke everywhere.
Everyone's just asking what's happened.
Only 2 months after Khan entered the Commons as a Member of Parliament, London was attacked by Islamist extremists.
That day will stay with me for the rest of my life.
He spoke out against the attacks both as a London MP and as a Muslim.
He has been very clear about his opposition to violence, opposition to terrorism, and has set out to make the case for a more open and peaceful Islam.
That's Thomas Penny, one of Bloomberg's Westminster correspondents.
Here is a man who is a Muslim, and he is standing up and being open and straightforward and being clear that the problem here is not Islam, but it's Islamic extremism.
In 2015, a decade after the attacks, Khan ran for mayor of London, and his faith was back in the headlines. His opponent, Zach Goldsmith, trying to link Khan to radical Islam.
The debate got again personal and nasty. The Goldsmith camp has called Khan extreme and accused him of associating with, quote, those who seek to do our police and capital harm.
It's a pattern of behaviour.
Even the former Prime Minister David Cameron repeated the allegations.
He shared a platform with Sajil Shahid, the man who trained the ringleader of the 7/7 attacks and accused the United States of bringing 9/11 on themselves.
But the smears didn't stick.
Zach Goldsmith ran a very negative campaign that was based on what people knew was a lie.
This election was not without controversy. And I'm so proud that London has today chosen hope over fear and unity over division.
After taking the mayor's office with a comfortable majority, Khan has brought a business-like efficiency to the role, scrapping expensive vanity projects like the Garden Bridge and the new Routemaster buses, which cost £350,000 each. The former lawyer who used to fight the police in court is now praised for his close relationship with them.
I was talking to a very senior police officer in the Metropolitan Police who said there was a sea change when he went into City Hall, and the police were saying how much they welcomed this because they knew where they stood and it was more straightforward to work with. So he works like a lawyer, he works like a government minister.
Khan's kept his faith at the fore. He's an outspoken voice for moderate Muslims across the world.
Donald J. Trump is calling for a total and complete shutdown of Muslims entering the United States.
Now, by giving the impression that Islam and the West are incompatible, you're playing into the hands of the extremists.
The ongoing spat between Khan and US President Donald Trump escalated when Trump went after Khan, misquoting him on Twitter just hours after the terrorist attacks of June 3rd, 2017. Khan's now one of the most prominent Labour politicians in the UK. In fact, a recent poll of Londoners found Khan was more trusted to keep the country safe from terrorism than the Prime Minister or the Labour leader. His story of going from the son of an immigrant bus driver to the mayor of one of the greatest cities in the world plays well with Londoners. But can he appeal to the rest of the nation? Has Khan got his eye on the top job? And is the UK ready for a Muslim Prime Minister?
What does it take to change the world? A big army? A cure to a pandemic? A revolution? All of these take either a lot of people, thousands of hours, or massive amounts of space. But for Julian Assange, all he needs is one room, an internet connection, and the world will listen. Assange is located here, and more specifically, right here. And from that location, he's posted government secrets, classified documents, and leaked emails from some of the world's most powerful people. And in doing so, has been labeled a hero, a villain, a nihilist, and everything in between. This is how an Australian programmer sequestered in the Ecuadorian embassy in London became one of the most influential and notorious people in the world. Born in 1971 in Townsville, Australia, Assange has always been on the move. Living in over 30 homes by the time he was in his mid-teens, Assange, along with his mother and half-brother, finally settled down in Melbourne. His introduction to hacking started at 16 when he was given a Commodore 64, which he attached to a modem. He attended the University of Melbourne, where he studied programming, physics, and mathematics. He never graduated, but that doesn't mean he didn't get an education. By 1991, Assange hacked into the Pentagon, U.S. Navy, and other branches of the U.S. government. In 1996, he was caught by the Australian Federal Police and charged with over 30 counts of hacking and computer-related crimes. He didn't get any jail time, but he was fined $2,100.
I think the first taste of what would come later was the hacking that he did as a young programmer, and that really sort of foreshadowed a healthy skepticism of the use and abuse of technology by governments.
That's Vernon Silver.
I'm a reporter for Bloomberg's investigations team.
Assange's youth as a hacker laid the foundation for him to start WikiLeaks in 2006. But what is WikiLeaks? It's a website that posts unfiltered, usually classified documents. What separates it from every other media outlet is that they have no editorial hierarchy. With a publication like the New York Times, information comes in, they take that information, package it, then disseminate it for the public to see. WikiLeaks, however, cuts out the middleman.
WikiLeaks gathers information, most of it given to them anonymously. So what they're doing is really very simple. They get the information in one end from who gives it to them and out the other with sometimes minimal interference. Julian Assange is the leader of that, the mastermind, the creator, and really, because he thinks of it as a journalistic enterprise, the editor-in-chief.
But every story starts with a source, and Assange has some unconventional sources.
Julian Assange does not hack as far as we know. He is the recipient of people who are either insiders who give him secret documents or hacked emails from a foreign power.
That's Eli Lake.
I am a columnist for Bloomberg.
And there was no source bigger for Assange than Chelsea Manning. He used to be known as U.S. soldier Bradley Manning. In 2010, Manning provided Assange and WikiLeaks with hundreds of thousands of leaked government documents. WikiLeaks quietly began releasing the documents in February of 2010, then made big headlines in April by posting what is now known as the collateral murder video.
Come on, fire!
It was a vivid, graphic...
90,000 leaked documents known as the Afghan war logs, 390,000 documents known as the Iraq war logs, and 250,000 private messages between diplomats called cables in what is now known as Cablegate. These leaks were met with very real ethical questions.
The problem with publishing those cables was that a number of confidential sources for U.S. diplomats who faced real danger when their names were exposed.
Then Secretary of State Hillary Clinton drove the point home that
every country, including the United States, must be able to have candid conversations about the people and nations with whom they deal.
Shortly after Cablegate, the Swedish government issued an arrest warrant for Assange on allegations of rape and molestation. He claimed the allegations were fabricated to get him extradited to the United States, a claim the U.S. government denied. Either way, Assange's next move was
to seek refuge in the Ecuadorian embassy, which really was the beginning of the new chapter in his life and what we're dealing with now, which is him being stuck in London.
What was supposed to be an office in an embassy is now Assange's self-imposed prison to this very day. But that doesn't mean he's slowed down. Since being trapped in the embassy, WikiLeaks has released files about Guantanamo Bay prisoners, Syrian political figures, and the draft to the Trans-Pacific Partnership. And then came the 2016 U.S. election.
Thousands of leaked emails showed Democratic Party officials possibly plotting against Bernie Sanders in his race against Hillary Clinton.
Over the course of 68 days, WikiLeaks released 20,000 confidential Democratic National Committee emails. In terms of the presidential race, if you look right here, when Assange released the first batch of emails, Trump actually takes his first lead against Clinton.
I think we've had enough of the Clintons, in all fairness.
Once WikiLeaks started exposing secrets of the Democratic Party, Julian Assange became a hero to many on the right. Public opinion kind of flip-flopped.
WikiLeaks!
From the emails, we now know Hillary Clinton's campaign manager makes risotto, and also how the DNC squashed Bernie Sanders' campaign. One thing we don't know is who gave Assange the stolen emails in the first place.
Many leading Democrats say they suspect it was the Russians. They released an analysis from a private cybersecurity firm that had said it was the Russians.
But Assange claims
our source is not the Russian government, and it is not a state party.
So this is where we stand today. The public still doesn't know who provided the emails to WikiLeaks. Meanwhile, Assange is still running WikiLeaks and still releasing documents. In March 2017, he started publishing documents from the CIA's Center for Cyber Intelligence called Vault 7.
The CIA, the agency charged with finding and keeping our top secrets, can't keep its own secrets.
As long as Assange has a connection to the world, no government secret will be too far from exposure.
Julian Assange is still in the embassy. Maybe he'll leave, maybe he won't. Kind of regardless, his work has been done. He's changed the way people think about their governments, about their own secrets, about their own hackability, and really the world has changed because of him.
it debuted, the 4G wireless we have today allowed people for the first time to hit the road and explore unknown places with only a smartphone for directions. When 5G arrives, it could enable driverless cars to take us there as well. 5G stands for fifth generation mobile networks or wireless systems. It's insanely fast and can accommodate a lot more connected devices. But the reason it's being called revolutionary is because 5G will allow connected devices to speak to each other as well as people.
Right now we're living in a world where really it's a one-way experience.
That's Bloomberg tech reporter Ian King.
The network talks to your phone, you look at your phone and access data, then you send something back to the network. What we're being told about 5G is that really for the first time we're going to see machines communicating with each other over mobile networks in a meaningful way.
5G could end up being 100 times faster than what we have now, with speeds that could reach 20 gigabits per second. In plain English, that means downloading a full-length HD movie in seconds. 5G will also increase total bandwidth, which we will need in order to accommodate the growing Internet of Things. We're talking about the class of devices like internet-connected refrigerators, thermostats, dog collars, but 5G will enable many, many more.
Things like your utility network, factories, where machines are just sat there, not connected at all. Suddenly they're all going to be connected. Suddenly we're going to be able to have real-time monitoring. Other things like cars, like utility poles, like your light, the light poles.
But perhaps the biggest advance will be a huge reduction in communication lag time, known as latency. A network of driverless cars will need the speed of 5G to ping each other multiple times per second to avoid collisions. Near instantaneous data transfers could allow doctors to perform surgery remotely with a robotic scalpel. So how will all this work? First, you need to improve network density.
And that's just a fancy word for saying you put more towers out there. What we're being told is that's not actually the case with 5G.
The idea is 5G will not only use the existing mobile spectrum, but also tap into higher frequencies called millimeter waves. Millimeter waves can carry more data, but only travel short distances. This may mean you'll see a lot more of these base stations around town. And the new towers may have as many as 100 antenna ports, compared to about a dozen on 4G cell towers. So when will we get 5G? Getting 5G ready is expected to cost providers $275 billion over 7 years in the US alone. Look for the first 5G service to pop up in big cities sometime in 2019.
People think of Vladimir Putin, they think of capital P, power. And that's exactly the impression he creates. Whether it's physical power, firing different weapons, riding in various James Bond-esque modes of transportation, or tossing hapless opponents in judo. Or political power, ruling his own country with an iron fist, crushing his political opposition, or, most recently, being accused of meddling in foreign elections for his own benefit. This is how Vladimir Putin went from a poor, tough kid in Leningrad to a KGB spy to the very symbol of modern Russia. Vladimir Vladimirovich Putin was born in 1952 in Leningrad, which is now St. Petersburg. His father was a factory foreman and his mother a homemaker. It is widely said that Putin's public-facing tough guy persona can be traced back to him getting into fights when he was younger, which paved the way for him to take up judo. After getting a law degree from Leningrad State University, Putin joined the KGB Foreign Intelligence Service. He spent 16 years in the KGB. When Putin returned to Russia, he began his political career.
He went to work for Anatoly Sobchak, who was then the mayor of St. Petersburg.
That's Leonid Bershidsky.
I'm a columnist at Bloomberg View.
Putin thrived in Sobchak's administration because
he was sort of considered pretty efficient city official at that time. He was very loyal to Sobchak.
So loyal and efficient that
he was noticed by Yeltsin's close circle.
And those people soon brought Putin over to Moscow to work in Yeltsin's administration, where he quickly climbed the political ladder.
Then, of course, he was promoted to Prime Minister of Russia.
That's Dmitry Trenin.
I am currently director of the Carnegie Moscow Center.
Around this time, Yeltsin and the people around him, the so-called family, decided that Putin would become Yeltsin's successor. And then this happened. The apartment bombings were carried out in 3 Russian cities, killing 293 people and injuring more than 1,000. Putin immediately accused Chechen separatists for the bombings and followed it up with action.
He was credited with having a very successful military campaign against the terrorists.
And it worked.
After that, he became an heir apparent in the eyes of the Russian people.
3 months later, Yeltsin resigned. And on his way out, a famous exchange.
He was getting into the car in the Kremlin, and the last words that he addressed to Putin before getting into his car was, "Take good care of Russia."
So Putin took over as president, and 3 months after that, won his first election. But just because Putin won the presidency, that didn't mean he had all the power. This is Michael McFaul.
I was U.S. ambassador from 2012 to 2014. In the 1990s, there was a fire sale of all the things worth owning in Russia, and certain people,
the oligarchs,
did better than others in that fire sale, sometimes called privatization, and those people tended to be well connected with the Yeltsin regime, and they weren't Putin's friends. But they probably miscalculated, thinking that they could easily find a way to influence him. It became impossible almost from the start. From that very moment, there was warfare between him and the oligarchs.
That's when Putin gave the oligarchs a choice. Putin's way?
Some of those people from the 90s managed to figure out a new way of dealing with Putin and have survived.
Or prison.
Others could not find common vision, and so they lost their assets.
Khodorkovsky once was Russia's richest person, worth $15 billion, but he ran afoul of President Vladimir Putin and spent a decade in prison.
With domestic power consolidated, Putin focused on restoring Russia's global influence.
Putin is the guy who believes in the expansionist Russian state. Georgia and Ukraine and all the other Soviet republics that split off when the Soviet Union fell apart, he still believes that they're traditional Russian satellites. A lot of his strategy is about keeping them in the orbit. That Yeltsin line, take good care of Russia, that's how he understands it.
And he used annexation and invasion, as well as oil, gas, and trade to keep former Soviet republics in Russia's orbit. In 2008, Putin's 2 terms were up, and he decided to step down as president. Dmitry Medvedev stepped in as president, and Putin went back to prime minister. But really,
Putin never left power. He pretty much continued running the country, and Medvedev was a bit of a figurehead.
There was actually a period of cooperation between Russia and the U.S. that benefited both countries during Medvedev's presidency.
Because Medvedev did not have the same negative attitude towards the West as Putin did.
But when Putin came back to run for a 3rd term, in the lead up to the 2012 election, it was widely believed that both the presidential and parliamentary elections were rigged, and Russians took to the streets. Putin blamed the protests squarely on America, and more specifically, Secretary of State Hillary Clinton.
He believed that she had sent, and this is his words, a signal to demonstrators.
Still, Putin won by a huge margin and set about crushing the protest movement immediately upon his return to the Kremlin. Over the next few years, Russia's economy tumbled. Putin annexed Crimea, leading to sanctions. The price of oil fell drastically. The ruble hit a new low, and America played down Russia's influence, with Obama calling Russia a regional power. Despite all of that, Putin's approval rating remained sky high, and then an opportunity for payback.
I think I'd get along very well with Vladimir Putin.
In 2016, there was one candidate who called Vladimir Putin very smart.
Trump exhibited tolerance towards Putin's actions annexing Crimea, and similar views on NATO and sanctions.
Secretary Clinton didn't support any of those views.
even though Putin denies any wrongdoing,
U.S. elections.
Yes.
the U.S. has accused Russia of being behind the leaking of 20,000 Democratic National Committee emails, which many say helped Trump beat Hillary Clinton in the presidential election. Which leaves us here, with the possibility of a President Putin until 2024, positioning Russia to be the world power he always imagined it should be.
Jack Ma is Asia's richest man and most recognizable business tycoon. He's the chairman of Alibaba, China's e-commerce giant and one of the 10 largest companies in the world. Yet he still wants more.
We know where we're going. We want to be the 5th largest economy.
Big words from the man some call Asia's Jeff Bezos. He's confident, he's charismatic, and he's definitely not the average CEO. This is how a poor school teacher went from the classroom to being one of the most influential multi-billionaires in the world. Ma was born in China's southeastern city Hangzhou in 1964. His parents were traditional musician storytellers. As a teenager, he started to learn English from foreign tourists after China opened up in the late 1970s.
And then for 9 years, Jack Ma hung around outside the Hangzhou Hotel, which is now called the Shangri-La. He would get up at 5 a.m. to talk to travelers.
That's Bloomberg technology reporter Lulu Chen.
And I cover China Internet for Bloomberg.
Ma failed China's National University entrance exam twice before being admitted to local teachers' college. He graduated in 1988. He applied for 30 jobs and got rejected, including from the fast food giant KFC.
When KFC came to China, capital say, 24 people went for the job. 24 only 3 people accepted. I was the only guy.
Then Ma got a job at a local university and taught English there for about 5 years, earning just $15 a month. On the side, he started a translation company with several friends. During a company trip to the US in 1995, Ma had his first encounter with the internet at a friend's place in Seattle.
I searched the first word, beer. I don't know why, because it's easy to spell, baby. And I see beers from Germany, beers from USA, beers from Japan, but there's no beer from China.
So he searched for the word China instead and still couldn't find anything. And that got him thinking. He wanted to build something that would put China on the world's map.
He started China Pages, a Yellow Pages-like website, but it didn't take off. Then Ma joined a government agency in Beijing to help set up a website. By 1999, the internet stock boom had gripped Wall Street, and back in his Hangzhou apartment, Ma decided to try again. With his wife and a group of friends, Ma raised $80,000 and set up Alibaba, a site that allowed businesses to sell stuff to each other.
人家美国人强，就强它的硬件，强就强它的系统基础，这方面确实比你高。但是玩信息玩软的，中国人的脑袋绝不比你们差。我们在座的所有人的脑袋绝不比你们差。
By 2000, Alibaba had raised $25 million from investors, including Goldman Sachs and SoftBank.
He had no business plan and zero revenue, but his eyes was very strong eyes.
In 2003, Alibaba started Taobao, a platform for individual sellers to trade with each other, and publicly declared war against eBay, who had started to make a foray into China.
Jack Ma has this famous saying that Alibaba is a crocodile in the Yangtze River, whereas eBay is a shark in the ocean. And if they fight eBay in the ocean, then they'll lose. But if they fight them in the Yangtze River, then they have a home base advantage.
In 2007, just 1 year after it forced eBay out of China, Alibaba debuted its business-facing division on the Hong Kong Stock Exchange. But it delisted 5 years later as its performance sagged. But in 2014, Alibaba raised $25 billion in the world's biggest IPO in New York.
Everybody should have a dream. What if that dream comes true?
After achieving dominance in the business of e-commerce in China, Alibaba has been building an internet empire worth $472 billion, with businesses in cloud computing, online video streaming, movie production, healthcare, sports, retail, and even news media.
Alibaba buying into South China Morning Post really raised eyebrows. This is the largest English newspaper in Hong Kong, and it shows that Jack Ma's ambitions weren't limited to e-commerce. He wanted to influence not just Chinese users, but also overseas users as well.
The US has criticized Alibaba for allowing companies to sell counterfeit and poorly made goods, but in China, it enjoys the favor of China's government. It's part of Ma's company philosophy.
In love with the government, but don't marry with them.
Jack Ma is an extremely fortunate man for jumping on the internet sector so early. Note that this is a person who has no coding skills at all. He's a natural showman and a gifted public speaker and really able to convince others to believe in his vision.
Ma's vision of growing Alibaba to be the world's 5th largest economy faces strong competition at home and abroad. It will require more than just naked ambition and charisma, but Ma is great at getting himself in the right place at the right time. So far, it's served him well.
Thiel is a walking contradiction. He got his bachelor's and Juris Doctorate from Stanford, but speaks out about the horrors of higher education, saying college is
as corrupt as the Catholic Church was 500 years ago.
He's a staunch supporter of the free press, yet he bankrolled a lawsuit to bankrupt an independent media company.
But these were not journalists.
And most of all, he's an immigrant libertarian who's the most public supporter of Donald Trump in all of Silicon Valley.
What Trump represents isn't crazy, and it's not going away.
This is the story of how an openly gay, immigrant genius, libertarian billionaire went from tech contrarian to Silicon Valley's biggest Trump supporter. Peter Thiel was born on October 11, 1967 in Frankfurt, West Germany, to Suzanne and Klaus Thiel. Peter's family emigrated to Cleveland, Ohio when he was 1. An Ayn Rand devotee during his youth, Thiel attended Stanford University majoring in philosophy.
His Stanford experience shaped a really big part of who he decided to surround himself with.
That's Lizette Chapman.
And I cover technology and venture capital here at Bloomberg.
He and his Stanford friends made their first big splash in tech with PayPal. After selling to eBay for $1.5 billion, they would become known as the PayPal Mafia for each incredible success after PayPal. For Thiel, that began with an early, modest $500,000 investment in Facebook.
And in VC speak, early means big risk, but also big reward. He turned that initial $500,000 investment into more than $1 billion in cash.
But Thiel was just getting started with Facebook, and he went on to make a whole bunch of wildly successful investments.
From SpaceX to Airbnb to one of the largest, most powerful companies in the United States, if not the world, and of course that's Palantir.
The incredibly controversial secretive data mining startup he founded with his colleagues from PayPal. It connects data silos and then allows non-technical people to search that information for patterns. Data like
financial information, feeds from video cameras, biometric details, passport information, flight manifest.
Palantir doesn't talk much about how they collect this data, who has access to it, or what they do with it. But they have contracts with
the Department of Homeland Security and the CIA and the Department of Justice and the Securities and Exchange Commission
and several other federal agencies. It's the richest company you've never heard of, valued at $20 billion. But there are plenty of obscenely wealthy people in Silicon Valley. What makes him different...
He's a complex ball of multiple contradictions.
Take college, for example. Even though college was extremely important for Thiel, there's something called the Thiel Fellowship.
In exchange for dropping out and a promise not to pursue college, Thiel would give them $100,000 each.
You basically tell people that if you get a diploma, you're saved.